Year for the yen, but we haven't got that in the board because it didn't quite go through 150. We're on 150 watch though. It's not far from it, but this is where we are in Asia Pacific stocks selling off. The US 10-year yield, part of the reason for that. The euro 104.73 as we continue to watch that weakness. Certainly that was a focus for markets yesterday. And the Brent crude price at 90.41, dropping a little, down by 0.3% with a 90 handle, Tom. That is not the 95 that we saw last week. So getting a little bit of respite there on oil prices and on commodities.
Yeah, the oil price respite though not leading to any upside in terms of these equity markets. Futures pointing lower for Germany by around 0.4%. Here in the UK, the FTSE 100 pointing down by 15 points. Over in France, you're looking at a drop of maybe 0.5%, Anna.
Okay, so looking to a bit of weakness at the start of the European trading day. That certainly would be in keeping with what we've seen through the Asia session. The higher yields, the stronger dollar, all of that taking its toll on risk appetite. That was the story through Asia. How much will that filter through into Europe today? We did a little bit of this story yesterday, of course, but we're continuing to watch those yields ratchet higher, those cycle highs, new cycle highs on the 10 and 30-year yield. All of that continues to do more damage. So the Spanish IBEX down 0.5%, the FTSE 100 down 0.2%. This is what we see on FX markets then. This is the ongoing strength in the dollar, although to Mark's point at the end of the last hour, a little bit less strong than it was at the start of the last hour. The euro fairly flat, the pound fairly flat. As I mentioned, still on dollar-yen watch. Will we get to that 150 mark? And our colleague Mark was pointing out all the options pricing, keeping it in check at the moment, and suggesting if it goes through 150, then it could really move further than that. This is the sovereign bond column then. We're seeing actually in Europe a bit of a different picture to yesterday. Yesterday, we continue to see the bond sell-off in the US, higher yields, and as Marcus Ashworth was writing about, that really did do damage to European bond markets. Well, today looks a little bit different. We see some buying there, and we see some of those yields coming down on sovereign bonds. Tom, what do you see on the sector picture?
Well, just one sector clinging on to some very, very modest gains in food. Every other major sector is in the red. Let's focus in on the energy story again. So this is a theme, of course, that continues from yesterday. Anna flagging the fact that Brent is around or just below that $90 a barrel level. And, of course, there's a squeeze there. The analysts say, look, this is less about the fundamentals, more about that dollar story, more about the yield story. Energy as a sector currently down 0.3%. Basic resources also taking a knock, down 0.5%. You do have some coming back in terms of the traders in Hong Kong after that holiday. Mainland China remains closed. Tech is currently down 0.5%. And in terms of what's happening across the retail space, 0.6% is the downside there. The banks are under pressure as well by about 0.4. Utilities lower as a sector, ended lower, amongst the biggest losers across your sectors yesterday and today, down 0.7%. Across the benchmark, you're looking at losses of around 0.2%, Anna.
Okay, so fairly broad-based then, those modest losses across European equity markets. Let's talk about what's going on the markets today with Christine Aquino, who joins us once again from the Markets Today blog to take us through her thoughts. And Christine, you can't move for comment and reference to treasuries right now. That seems to be what it's all about. I mean, what is it that just keeps driving treasury yields higher? We've talked a lot about the long end of the curve, and maybe there's nervousness around supply there. And is it the fact that we're not getting much pushback from all of the Fed voices we're hearing? They're not saying, hang on, we've gone far enough, we've priced in enough hikes. We're not getting that kind of commentary, and that just leaves the way clear for higher yields.
Yeah, absolutely. And I mean, it really is a combination, again, of the supply issues that you mentioned, and of course, ongoing concern about the ballooning deficit that just really keeps growing in the U.S., but also the fact that, yes, we are in this higher for longer longer environment. And when we say higher for longer, it really is not just about the rate itself. It really is also about the corresponding inflation that central banks will have to keep dealing with for some time. And I think there really is a realization in the last few weeks in the bond market that, hang on a minute, with rates staying as high as they are for a foreseeable period, we're also going to have to deal with inflation that's really going to be above target much longer, perhaps, than central banks were hoping or expecting. And we're really seeing that in a movement in yields, not just in the U.S., but really across the world.
Yeah, and arguably that high yield story is not helping the Bank of Japan. We remain on 150 watch for the yen, currently at 149.67. How are we thinking about the potential for intervention from officials in Japan?
Well, Tom, I mean, certainly on high alert at the moment, especially because we are hitting those levels again that we have seen in the past, very much made the Ministry of Finance in Japan nervous. And, you know, it's very interesting dichotomy here that we're seeing because, of course, the impact on the yen is very much coming from the Bank of Japan's policy of really sticking to that yield curve control measure still, right? I mean, even though they have indicated some baby steps away from that and more toward normalizing policy, it's very clear that their priority is to keep yields in check. It's also very clear that they are very much leaving the management of the currency itself to the government, which is, of course, under its remit, but of course puts the government in a tight spot, having to really watch the yen levels and make sure that it doesn't go much weaker than it currently is.
Yeah, remain on intervention watch as the yen skirts that 150 or literally flirts with that 150 level, currently 149.68. Christina Kino, thank you very much indeed. From our Markets Today blog, walking us through some of the key market themes. You can get more, of course, from Christine and the rest of the team on the front page of the Bloomberg UK website or by typing TLiveGo on the terminal. Let's take a look now at some of the other big events we are watching out for today. 1 p.m. UK time, we're going to hear from Atlanta Fed President Raphael Bostic, who's participating at a roundtable discussion. Interesting to see what he says on the back of Loretta Mester's comments that maybe additional hikes are needed from the Fed. And at 3 p.m. London time, the key data drop of the week, we're going to get the monthly US jobs opening numbers from the Labour Department. We also, of course, have later this week non-farm payrolls, arguably as consequential, if not more consequential. Throughout today, we're expecting a number of ECB speakers, including Philip Lane, and we've been hearing from Philip Lane, in fact, on his views around inflation, and Francois Villeroy de Gallo. We're going to bring you highlights and headlines as they cross the terminal. And at 3 p.m. UK time, Bridgewater Associates founder Ray Dalio, heard of him? He's going to be speaking exclusively to Bloomberg from the Greenwich Economic Forum in Connecticut. That's going to be interesting to hear what he says. He takes very much a macro look now. He has strong views on China, and of course, he may well talk about the US and the deficit problems as we look at what's happening in the bond markets in the US.
Lots to focus on when it comes to the jobs story in the US a little bit later on. We've got the job openings story, of course, to zoom in on. And actually, we've seen these numbers coming down in keeping with these cracks in the labour market that we've been talking about since January 2022. But Bloomberg Economics actually saying that they expect this number to increase today. They're not reading too much into that, but they do say that that could be a risk. Although the overall estimate is for that number to drop on the sort of Waco function on the Bloomberg terminal. But that's going to be a focus. Still looking for cracks in the labour market, really, aren't we? Even as the focus more on the sort of the downturn, the weakness in the US economy, rather than maybe the labour market.
Well, it doesn't seem that long ago that was 2 for 1, the ratio in terms of job openings for applications in the early part of this year, pointing to the strength that was coming through for the US labour market then. But yes, we are seeing a little bit of fragility, and it ties into the Bloomberg Economics piece yesterday from Anna Wong and team, Tom Orlick, of course, in terms of the expectations that the US is unlikely to avoid that soft landing because they are starting to see some fragility. That was part of their argument in that labour market.
Yeah, absolutely. And you mentioned Philip Lane. We've already heard from Philip Lane, and he's putting the focus on how long it will still take to bring down inflation, saying we still have 2 more years of fairly large wage rises. That's his commentary, a host of comments on the Bloomberg terminal from Philip Lane speaking then this morning. Coming up on the programme, we will talk more about the Fed. Cleveland Fed President Loretta Mester says 1 more US rate hike will probably be needed this year to tame inflation. More on that next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg.
Is turned to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
This is Bloomberg Markets today, 10 minutes into our European trading session, and higher yields, stronger dollar taking their toll on risk appetite. You can see European stocks just under pressure a little bit. We are down a couple of tenths of a percent on the Stoxx 600, 1/4%. In fact, the FTSE 100 holds up a little better than the rest. The CAC and the DAX both down 0.4% this morning. Let's get to some of the individual stocks on the move. Joe Easton has a briefing. Joe.
So we are seeing sharp declines in the online clothing retailers today after that warning from Boohoo saying sales could fall as much as 17% in the year ahead. That stock leading declines in the UK down around 9% as customers do cut back on their clothing. Also hitting ASOS, who warned just a couple of weeks ago that they'd had a poor summer, partly due to weather, and we're seeing declines as well on Zalando over in Germany. The German online clothing peer getting hit as well. Red across that sector this morning. Greggs coming down a bit. That sales update looked pretty strong. Double-digit sales growth in the last 13 weeks. However, potentially moving lower with the broader market. And that one still remains quite a highly rated stock in terms of its valuation, given the gains that we saw a few years ago for that one. Then we'll flip over and I'll try and remember what we were going to do on the next board. As usual, I have completely forgotten. Novo Nordisk, of course, we had that one in stocks to watch. They won a patent dispute in the US. The tribunal there said that Mylan, the US firm, is not able to copy one of the compounds that they use in the key drug Wegovy. That one's actually the best performer on the Stoxx 600 today. And meanwhile, we've got Sika, which makes grouting, so a very glamorous one there, grouting that goes in tiles. They've issued a sales update, not as strong as expected over in Switzerland. That one coming down. Then we've got Burberry, as we said in stocks to watch as well. UBS cutting that one to sell, among 4 analysts now saying they should sell that stock. This after the latest collection from the new creative director, Daniel Lee, which I saw on their website includes a hot water bottle which prices at £290. It's one way to spend 300 quid, I guess. But anyway, we've also got Bruno Cucinelli going the other way. They've got an upgrade from a broker over in Italy. Second upgrade, Goldman went by a few days ago on that one. A lot of positivity on cashmere sweaters. Meanwhile, moving over into kitchen suppliers, Rational Group over in Germany, they make combi ovens that go into restaurant kitchens. They're seeing weaker orders, according to Berenberg, that one coming down 4%. And finally, JP Morgan goes overweight Technip Energies, the industrial engineer supplying into the energy sector. They say rising oil should benefit that one, and that one is up 2.3% in Paris.
Joe Easton. Yeah, what are you going to do with a £300 hot water bottle?
Seems a bit extra.
Surely the prospect, part of the rationale for buying luxury is so you can show it off to people, right? In terms of, I mean, it depends how many people you have in your bed, I guess. But 300 quid for a hot water bottle. I was also expecting, Joe, a little rundown of the menu from Greggs, but we'll come back to you on that one because you always cut. Chicken Goujon's doing well on Greggs. Thank you, Joe. Joe Easton, of course, from our equities team on the important stocks on the move this Tuesday morning. Let's get back to the macro now. Cleveland Fed President Loretta Mester has signalled that further tightening may be needed this year to bring down inflation. Mester, who doesn't vote on monetary policy this year, said inflation remains too high and the risks are still tilted to the upside.
At this point, I suspect we may well need to raise the Fed funds rate once more this year and then hold it there for some time as we accumulate more information on economic developments and assess the effects of the tightening in financial conditions that has already occurred. But whether the Fed funds rate needs to go higher than its current level and for how long policy needs to remain restricted are really going to depend on how the economy evolves relative to the outlook.
OK, let's bring Freya Beamish now, Chief Economist at TS Lombard. Good morning, Freya. We have a market that's reassessing their expectations around a potential hike from November from the Federal Reserve. We had additional officials, of course, coming out signalling that at the very least higher for longer remains the narrative, and then some, like Loretta Mester, flagging potentially additional hikes coming through. Where do you land on this debate, given so much work has been done by the bond markets to tighten financial conditions?
Yeah, they don't know. And to be fair, if anyone tells you they do know, then they're probably a little bit egotistical because there's just so much uncertainty about the US outlook. We do think that probability, when it was hanging about kind of 50-50, that was a little bit too low for the November hike, just because of that uncertainty that's still out there. And the reason why there's so much uncertainty is because we are in unprecedented times with regards to the wealth ratio in the US. So the amount of wealth that was created by the pandemic. In the US, that is still overhanging, whereas in the rest of the world, it's very much diminished. In the UK, it's actually completely gone. So in the US case, all of that kind of tightening that has happened already is sort of much less effective on the economy. The economy is sort of desensitized to the tightening of monetary policy by the kind of the cushion of wealth that is left over. We still do think that you can get a recession. A little kind of thought experiment that we've been doing is to think of, well, you've got the household sector and they're sitting pretty with this extra wealth. But you don't get more spending out of them. They can sort of maintain their spending. They can maybe continue to buy their luxury hot water bottles, but they don't grow their spending because the stock of wealth is larger. To understand what's going to happen to GDP growth, noting that GDP is a flow, we have to look at the change in the change in the impulses coming into the economy, and those are negative for the moment. So we've got negative credit impulse. And that tends to be a coincident indicator with GDP growth. There is, though, this kind of desensitization to the impulses because of the excess kind of stock of wealth, and the fiscal impulse has been adding to growth as well. So there's a lot of uncertainty out there, and that's why the Fed just has to play it by ear.
Okay, a lot of uncertainty, and you make the point you're watching the change in the change, if you like. Let me ask you about what breaks from here, Freya, if anything. I was reading an interesting piece by our colleague John Authers, who was saying that, the surging bond yields, we talk about it day after day, and you just wonder what will break. Is there something, an asset class that you have in mind? I mean, people are talking about how corporate credit isn't necessarily priced for the level of rates that we've got right now and the risks surrounding defaults there. What are you looking at?
that's true. In terms of defaults from the real economy side, what we're seeing is only at the kind of the most risky end, you're starting to see delinquencies pick up in, for instance, credit cards in the household sector. And that's the kind of the early warning signs that you might kind of look to for things starting to be more painful. But again, this is more of a sort of it's almost like a statistical correction if there is a recession. It's not like there's something that needs to be corrected in a global financial crisis sense, or in the sense that you have in China currently. It's more just like the economy has overrun. It's well above its kind of trend rate of growth in terms of the levels. And it needs to slow down a little bit. So in terms of something breaking, I think the likelihood of something breaking is actually quite strong, because you still have the kind of the legacy of that long period of low rates is still with us. And the authorities need to drain the swamp. And when you're draining the swamp, you're going to find out that kind of something is there beneath the surface. But it's really hard to actually get real yields falling until those recessionary numbers come through. The mechanism for yields falling would be you drain the swamp, you continue with the QT, you perhaps have a little bit of help with the Bank of Japan continuing to normalize rates and to normalize policy. You have the TGA rebuild, and that's all draining the swamp, and that pulls up real yields. And that tends to pull down growth and inflation, and then you stop draining the swamp, and you perhaps get a fall in real yields at that stage.
Well, talking of draining the swamp, we've been hearing from Philip Lane of the ECB suggesting that more work needs to be done, not at the inflation target yet, more work has to be done. But you're concerned that maybe there's over-tightening coming through from the ECB?
Yeah, we can have a lot more conviction on the European case than we can have on the US case. And I think that's why the dollar story is so popular at the moment. A lot of uncertainty on the US case. In the European case, that cushion of wealth is pretty much gone. If you include housing, there's a little bit of a cushion left, looking at sort of financial wealth and housing as a percentage of GDP in the euro area. In the UK, we've actually gone negative. So we've got less wealth than we had prior to COVID, and even before that, as a percentage of GDP. So there's nothing there. There's no buffer in the UK case, and there's only a very small buffer in the European case. And that really tells me that the ECB and the Bank of England have been fighting a very different inflation monster than the Fed has been fighting. They've been fighting imported inflation. They've been fighting negative supply shock-driven inflation, cost-push inflation, and all these types of things tend to destroy demand by themselves. They really didn't need so much of the kind of the tightening probably from the Bank of England and the ECB. And so the outturn is in terms of the relatives, the likelihood is the ECB and the Bank of England probably have even over tightened by this stage, whereas the Fed, it's not even clear that they've done enough tightening.
Freya, thanks so much for joining us. Freya Beamish, Chief Economist at TS Lombard. Coming up on this programme, watch collectors are still wary of spending big on top Swiss brands. We will discuss the market for fancy timepieces next. This is Blingo.
The IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back. Now, prices for pre-owned Rolex watches kept falling on the secondary market last month. Meanwhile, entry-level models and brands like Cartier and Omega have fared slightly better. For more on the market for fancy timepieces, let's bring in Bloomberg's Swiss watches reporter. What a gig, Andy Hoffman. Andy, has the secondary market then for luxury watches finally bottomed out?
In a word, Tom, no. Prices are continuing to fall. We now have sub-indexes, branded indexes, part of the Bloomberg Subdial Watch Index. We saw Rolex prices fall about 2.2% over the past 30 days. The overall index, which includes the 50 most traded watches by value, so lots of Rolex, Patek Philippe, Audemars Piguet, down about 2% over that same period. We also now have cheaper sort of entry-level watches, an index separately for that. That was only down about 0.8% in the past 30 days.
Okay, so you mentioned a few of the brands there, but what is it that collectors enthusiasts are looking for right now?
Well, you'll remember that basically prices for luxury watches, particularly Rolex, Patek Philippe, and Audemars Piguet, went crazy during the pandemic. And once interest rates started to rise, about in March, April 2002, prices started coming off. We're still there, but it seems like what collectors and enthusiasts are looking for now is more value. So they're moving to brands like Cartier, like Omega, like Breitling, and even Tudor, which is the sister brand to Rolex. And so those watches have still declined in price, but they have declined at a less precipitous rate than the big, most hyped watches. So we've in fact seen prices for Cartier watches up over 12 months during the year. Up slightly, whereas prices for Rolex or prices for the overall index are down about 12%. Thank you.
Thank you very much. Andy Hoffman, our Swiss Watches reporter. Coming up, JP Morgan CEO Jamie Dimon. We talked to him about AI. This is Bloomberg.
focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. One more, European equities and US futures drop as Cleveland Fed President Loretta Mester says the US may need to raise rates once more this year and hold them at higher levels for some time. Standing pat, the Aussie dollar and bond market remain unfazed as the RBA keeps rates unchanged but warns further tightening may be required. Plus, JP Morgan CEO Jamie Dimon says AI will lead to a 3.5-day work week for some. We'll bring you more of that exclusive interview. And Tom, that coming up shortly, more of that AI conversation. European equity markets then sluggish at the start of trade, very much the hangover of the higher rates, stronger dollar story we saw through the Asia session, but London turning corner just a little.
Yeah, building on the downside across the benchmark, down 0.3% as things stand. The inflation picture out of the UK is interesting. You're seeing moves in the gilt market on the back of that, money moving into gilts and yields coming down. And that is on the fact that grocery prices, shop prices have come off. And so expectations that maybe we're seeing a little bit more certainty around the downward trajectory of inflation here in the UK. Across the benchmark, as I said, losses of 0.3%. Over in Germany, the DAX taking a hit of about 74 points, down 0.5%. The FTSE 100, though, flat as things stand, just gaining a little under a full basis point, 7,511. Interesting that you get a call from the likes of Citi and Bank of America saying, and this, of course, reflects with the CAC, but also the UK, the FTSE 100 as well, that maybe now is the time to buy the dip on luxury. Let's switch the board and have a look at the sector picture. Then we'll focus, of course, on energy, but also basic resources, given that iron ore and copper prices are down in the session as well. So energy down 0.8%. That was one of the biggest losers across your sectors yesterday. Autos proving something of a drag, of course, for the DAX, currently down 0.6%. A big hit for utilities. That was the biggest loss leader in terms of your sectors yesterday. Utilities in the session today down 1.6%. And there's the basic resources picture, then down a full percentage point as well. There isn't much resilience across here. Food, travel and leisure, the least badly performing sectors across the board here. There are a couple of sectors in the green not reflected on this channel, or at least this board right now. Across your benchmark, again, losses of 0.4%. The FTSE 100 is range-bound. Anna.
OK, JP Morgan CEO then, Jamie Dimon, says AI is already being used across the bank. He spoke in an exclusive, wide-ranging interview with Bloomberg's Emily Chang in London.
It's a living, breathing thing. It's going to change. There are going to be all different types of models and different types of tools and technology. But the way to think about it for us is every single process, so errors, trading, hedging, research, every app, every database, you're going to be applying AI. So it might be as a co-pilot. It might be to replace humans. Like, AI is doing all the equity hedging for us for the most part. It's idea generation. It's large language models. It's note-taking while you're talking to someone. And while it's taking notes, it may actually say to you that, here's the thing of interest the client might be interested in. All error, all customer service. It's a little bit of everything.
But it is going to replace some jobs.
Of course, yeah. But I look, folks, people have to take a deep breath, okay? Technology's always replaced jobs. Your children can live to 100 and not have cancer because of technology. And literally, they'll probably be working 3.5 days a week. So technology's done unbelievable things for mankind. But, planes crash, pharmaceuticals get misused. There are negatives. This one, the biggest negative in my view, is AI being used by bad people to do bad things. Think of cyber. Henry Kissinger talks about warfare. But the fact, and I do think, eventually have legal guardrails around it. It's kind of hard to do because it's new, but it will add a huge value. And for J.P. Morgan, if it replaces jobs, we hope to redeploy people. Like at First Republic, we've offered jobs to like 90% of the people. They accepted, but we also, we've told them some of those jobs are transitory, but we hire 30,000 people a year. So we expect to be able to get them a job somewhere local in a different branch or a different function if we can do that. And we'll be doing that with any dislocation that takes place as a result of AI.
The biggest tech companies prop up a huge chunk of the S&P. Is big tech too big to fail?
I think that's a too broad a question. I think in any industry, well, you say too big to fail, which I've lost touch with what that really means anymore, because remember, car companies were bailed out, and these things were bailed out, and I don't understand. They should ask what they want. If the regulators don't want a bank to ever fail again, then we should do A, B, C, D, and E. If that's the goal. I didn't think that was the goal. I think Dodd-Frank actually accomplished most of the goals, which is dramatically reduce the risk, create liquidity, capital, stuff like that. So, and big tech, you got to be very specific. Sometimes companies misuse their position, and sometimes they don't. Sometimes regulators capture it, sometimes they don't. But they're powerful, and we have to deal with that. I've been writing about, big tech going to our business. We got fintech, but we also have big tech, and they will embed payment systems in there. Some are going to white label banks, kind of what Apple did. They have the right to do that. I'm not against that. I would be against unfair use of their position to dominate us in a business.
Well, Apple is going deeper into financial services. Do you worry about the Bank of Apple?
I wrote about it. I wrote about it like 5 years ago.
Well, how worried are you now?
Like, what is a bank? Well, we're going to compete. So they have a tough competitor, but they hold money, move money. You could put money in basically markets, but it's a white labeled checking account, credit card, all these things. Yeah, they're a form of a competitor. We also partner with them, but I'm very used to partnering and competing with lots of people.
Existential threat?
I don't think it's an existential threat, but I think if we were complacent about it, yes.
Okay, JP Morgan CEO Jamie Dimon there speaking to us exclusively on the challenges and the opportunities around AI. His views, of course, on big tech as well, and the competition with Apple and their partnership with Goldman Sachs, Marcus offering. Interesting around the 3.5-day working week that he flagged there to Emily. And it brings me to a comment. Do you remember, well, I'm not going to try and 1930, so I'm not going there. John Maynard Keynes, famously, in terms of the essay that was published in the 1930s, did you remember, we're going to go there. People would only work for 15 hours per week, is what John Maynard Keynes, the esteemed and famous, famed economist, of course, back in 1930, because of productivity gains. Now you have Jamie Dimon saying we're going to be working 3.5 day weeks. I think you have to take that maybe with a bit of pinch of salt, whilst you're also going to weigh his smart analysis on like how this evolution is going to change the workplace.
Really exciting to hear his view, isn't it? 3.5. I wonder how he gets to the half.
The half is important.
That suggests some deep analysis, doesn't it? That wasn't just plucked out of thin air. 3.5. That's not 2, and it's not 5, it's not 4. Interesting. I mean, well, you still have to spend 5 days in the office. That's what I want to know if you're working 3.5 days. But that's a silly question. Interesting on tech displacement, though. Of course, at the individual job level, he's right. Tech has always replaced jobs, and that's what we've seen. decade after decade after decade, but not at the overall labour market level. And that's the concern with AI, isn't it? Because it has replaced jobs, but then those people have found jobs doing other things. That's why we have really low unemployment levels in many Western economies right now. So that's why people ask, is it different this time with AI?
Yeah, and what a lot of proponents will say is that you see a labour force, you're going to see a labour force that incorporates some of those AI solutions to empower workers, and it's not going to necessarily lead to that bloodletting. The question is, have you got the training in place when those jobs are let go?
Okay, let's stick with this theme, in fact. While investors have piled into AI bets this year, Wall Street has been slower to succumb to the new technology. Computers have struggled to decipher noisy markets, but there are signs that this is shifting. For more, let's bring in Bloomberg's cross-asset reporter and author of today's Big Take story, Justina Lee, with analysis. Justina, good morning. I'm really interesting that setting it up there with JP Morgan's commentary, because, of course, he was talking about what they're doing on the AI front. We've seen AI advances in lots of industries then. So how is the technology making a mark then in finance?
Yeah, I think a lot of Wall Street is using it the way a lot of industries are. I mean, when I spoke to hedge funds earlier this year, they were really excited about using ChatGPT to summarize all the reports they now don't have to read, or, you know, to kind of like read signals from a lot of the news that we write and a lot of the tweets that we post. I mean, a lot of quants are trying to get signals from that text data without ever having to read a word. But I think the holy grail remains like using machine learning to know where markets go next and to trade based on that. And I think a lot of hedge funds are still relatively cautious about that part.
What are the challenges? Why is it proven so difficult for the industry to incorporate AI to kind of shoot for those aims and those goals? Why is there still such a gap?
Yeah, that is a great question. I think if we kind of begin with definitions, I mean, like a lot of traditional quant models, I mean, you're beginning with the hypothesis. So you kind of know the logic behind your models. But with machine learning, you're sort of feeding all this data into a black box and asking it to detect these complex patterns for you and spit out a prediction. But the problem is financial markets are really noisy. So a lot of the time, the machine doesn't know whether it's kind of seeing signal or noise. And if you're just like finding patterns out of noise, then that is not necessarily going to work, you know, especially with like regime changes, is not going to work in live trading.
Okay, yeah, really interesting. So to the extent to which AI can disentangle the things it should be reading and the things it shouldn't. So where does this leave us then, Justina? I mean, are we at a point where some kind of AI can pick a load of stocks for us?
Yeah, I mean, I think a lot of hedge funds definitely are saying it can do that. I mean, I interviewed one based out of Berkeley called Volion, and they've always been at the vanguard of this fight. And I think you can see a lot more quant funds experimenting with AI for sure. But if you look at the track record so far, I mean, it's definitely not going to like shoot the lights out. It is not going to replace all the human stock pickers. And I think it just goes back to the same lesson, which is that predicting a market, especially as efficient as the US stock market, is just really hard. But at the same time, I mean, if machines can do as well as humans, maybe you don't need as many humans.
Yeah, or if machines show it's not possible. That also interesting in itself. Justina, thank you very much. Bloomberg's Justina Lee with the latest on AI, where it meets big finance. You can read today's Big Take story. NI Big Take Go is the function to use on the Bloomberg terminal. You will also find that story on the Bloomberg website. Coming up, we'll be speaking to the Bridgewater Associates founder, Ray Dalio. We'll be hearing from him from the Greenwich Economic Forum in Connecticut. You can catch that conversation at 3 p.m. UK time. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
When you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Markets Today, 8:43 in London, 9:44 in Paris or Berlin. European equity markets fairly range-bound this morning, actually off earlier lows, just down 0.1% now. You can see the FTSE 100 actually just into green territory up around 0.2%. Tom, what is your morning must-read for this morning?
Marcus Ashworth, Bloomberg opinion on how US yields and the US dollar are just powering through European debt markets. And Marcus is flagging the fact that, look, we're at yields now that are almost at decade highs in terms of European sovereign debt yields. And that's despite the fact that inflation is actually edging lower. So why is that? Well, he's pointing, of course, to the greenback, that run-up of about 6% versus a basket of currencies since around mid-July for the US dollar. And the fact that in terms of yields, you've seen about a 75 basis point addition in terms of 10-year yields stateside in about the same period. And he just says that is just charging through these European debt markets. No longer about the fundamentals of what's happening in Europe. It's all about a reallocation to US assets. Let's pull out the quote then that really stands out at the top of this piece from Marcus Ashworth as we think about then the linkages, or at least the ripple effects of this high yield, stronger dollar story for European assets. European bond markets are staggering into the fourth quarter, he says, having briefly reached the highest 10-year yields for a decade. This yield surge is more likely the result of ill winds coming from across the Atlantic and battering everything in their path, Anna.
Yeah, absolutely. So we talked to guests, haven't we, Tom, in the past about how, to what extent these markets are in charge of their own destiny, and to what extent do they just move on the coattails of what's going on stateside. And you wonder about other global flows then in that context. So, of course, we're waiting to see when the Bank of Japan steps away from its negative interest rate policy. And if it does so, and there have been suggestions for many months that it will, if it does, it removes that low anchor on low rates globally, and it perhaps gives more optionality to Japanese investors. Some of that money goes back home. And once again, then, perhaps that changes the story on treasuries.
Really key for the BOJ, and that's why it's such a central story, as you say, in terms of the yield, or at least in terms of the fund flows potentially back to Japan and what that could mean in terms of further pressure, as you say, across these global bond markets. It's worth noting today, of course, that in terms of the UK, gilts are actually seeing something of a bid, given the slightly softer prices coming through. But you're absolutely right, pointing out the centrality of the BOJ in terms of those fund flows.
Yeah, absolutely. Watching the yen in that context, 149.76, not quite made it to 150 just yet. Let's get to some of the other top stories that we're watching across the Bloomberg terminal. A Bloomberg News investigation has learned that several Taiwanese technology companies are helping Huawei build infrastructure for an under-the-radar network of chip plants across southern China. Staff from subsidiaries of Taiwanese chip material reseller Topco Scientific and L&K Engineering were present at a construction site in Shenzhen. It's unclear whether the company's potential involvement violates American sanctions. Bloomberg has approached them for comment. BYD is poised to overtake Tesla as the world's biggest seller of electric vehicles as the Chinese automaker's global sales push gains greater traction. China's best-selling car brand came within a whisker of toppling Tesla last quarter after factory downtime led to the US company's first delivery decline in more than a year. BYD sold more than 431,000 fully electric vehicles in the latest 3 months, up 23% from the previous quarter. Tesla shipped 435,000 over the same period. Evergrande Group shares have soared as it returned from a trading halt, driven by what appears to be bets on a penny stock, even as the developer's fate hangs in the balance. The property group's shares jumped as much as 42% in early trade before paring back some of those gains. This as the indebted Chinese property developer's billionaire founder faces an official probe.
Now, Delta Airlines says it's discovered unapproved components in a small number of its jet engines. The US carrier is now the 4th US airline to disclose the use of fake parts supplied by London-based company AOG Technics. Delta says the engines accounted for less than 1% of its fleet. Republican Congressman Matt Gaetz has officially moved to topple US House Speaker Kevin McCarthy. It sets up a high-stakes vote in a process that has not resulted in a speaker being removed since 1910. McCarthy's embrace of a bipartisan deal to avert a government shutdown triggered the call from the Republican congressman who sits on the right of the party. The House Speaker must call a vote within 2 legislative days. And New York prosecutors say former President Donald Trump overvalued his properties to get cheaper financing and rise up the Forbes billionaire list. Trump attended the start of his civil fraud trial yesterday. As the state presented its opening statement, Trump's defense team argues the claims involve only successful and profitable loan transactions with no victims.
Coming up on the programme, German economic softness has weighed on the Xetra DAX. But can Europe's engine find a jumpstart in the fourth quarter? We will discuss next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
City, from London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Markets Today. We are 52 minutes into the European trading day for this Tuesday, and we can see that European equity markets are fairly range-bound now. Off earlier lows, the FTSE is higher, the IBEX is higher. Elsewhere, we see a little bit of weakness on European stocks. Let's talk about one area of that weakness. German stocks are set to kick off the fourth quarter, lagging their peers after a dire September in which the DAX was the worst-performing major Western European benchmark. For more, let's bring in Bloomberg Market Live's Heather Burke, who's done some analysis on the German stocks, and I mean, the FTSE up, actually, in September, which surprised me when I looked at that. But let's stick with Germany. What is the state of the German story, the German economy, and the extent to which it's weighing on German stocks?
Yeah, so German stocks are cyclical. They're exposed to industrials, auto, and Germany has been kind of the poster child for some of the economic slowdown we've seen in the euro area. Manufacturing's really deeply in contraction. Confidence is really low. Inflation still remains pretty elevated, and we saw that reflected in the stocks that we're seeing. During September as into this month, we're seeing a shift into more defensive energy, and that's one of the reasons why the UK benchmark did so well, or relatively well, was because of its exposure to energy. That's something that Germany lacks, and if those trends continue with people more concerned about the economy, that's one of the reasons why Germany can continue to lag.
So what does the sector kind of composition tell us, and what are you going to be looking for when it comes to the earnings story?
I mean, what we're seeing is some of the big ones are industrials, auto, and chemicals. So we already had a really big set of profit warnings from chemicals earlier in the year. We also had industrial giant Siemens warning that they see a slowdown in China till next year. And autos, they're priced for a downturn. They're one of the cheapest sectors in Europe, although that's historical. So we've seen some sense of weakness in the last couple months. It wouldn't be more surprising to see some more profit warnings going into the third quarter as people really price in this slowing economic outlook. And the question is that priced into earnings? Earnings estimates for German companies have actually come down the last couple of months while they've stayed steady up slightly for the rest of Europe.
Okay, so that's an interesting divergence to watch. I know that Goldman Sachs also picking up on the sector composition, saying that this is a market that typically underperforms when the oil price goes higher. That's what's driving Germany, within Germany, and the sort of European dynamic. But Tom was just referencing that piece by Marcus Ashworth talking about how treasuries and what's going on with treasury markets and the dollar do seem to be in the driving seat for global bond markets to some degree. And that's no different in Germany.
Yeah, I mean, we're seeing German 10-year yields near 3%, some of the highest since 2011. That puts, for stocks even globally, that puts stocks in competition with bonds in terms of the earnings yield. The dividend yields have become less attractive. And that's something that is really an issue for U.S. and European stocks. But yeah, going back to what we're seeing in Germany and other markets seems to be really dictated by the treasury market. And it seems that in the last week or two, the investors are really waking up to the fact that higher yields are set in stone for time to come. The Fed is in a higher for longer mode. And even the ECB speakers we've seen over the past week or so have really said that, we're going to keep rates higher for longer, to fight inflation, to keep it. And, that's the question. Can they afford to do that with the economic outlook?
Well, to that point, Philip Lane, of course, the chief economist for the ECB, but also a voter as well, saying just in the last few minutes, the base case is to maintain this level as long as is needed. Do we take from that that is now the consensus, that they're on hold, but for an extended period of time?
I think that's the consensus. I mean, swaps rates are expecting the ECB to stay on hold into the first half of 2024, and you've seen a pretty steady session of ECB speakers, even Lagarde last week, saying, higher for longer. I mean, inflation has moderated, but it's still 4% odd. That's, twice as much as the ECB's goal. So that, from the inflation point of view, they want to keep higher for longer. The question is, if the economy weakens enough, is that going to make them waver in the higher for longer message?
Okay, Bloomberg analyst Heather Burke, thank you very much indeed on the assessment around the ECB's next step, and of course the lackluster DAX, at least by comparison to some of the other major indexes. Currently, European markets are down 0.2%, paring some of the heavier losses. US futures are flat. That is it for markets today. You can get more insights from the team on the front page of the Bloomberg UK website. Stay with us. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. European equities and U.S. futures drop as Cleveland Fed President Loretta Mester says the U.S. may need to raise rates once more this year and hold them at higher levels for some time. Oil falls for a fourth straight day to below $90 a barrel as rate fears overshadow physical tightness in the market. Plus, the J.P. Morgan Chief Executive Officer Jamie Dimon says AI will allow some people to work 3.5 days a week. We'll bring you more from our exclusive interview. Now let's take a look at the European markets map. A lot of the focus, of course, is on interest rates longer term. A lot of not only, of course, officials from the ECB, but the Fed have been speaking out, giving us a sense of how much longer or for longer they'll stay at these kind of hawkish signaling from the Fed. The other thing that we need to watch out for is actually one of the UK fast fashion retailers, Boohoo, amongst one of the sharpest decliners in Europe, down some 10%. Now, the dollar is strengthening against most of its major Group 10 peers. Again, the one thing we need to watch out for is yen, because there is talk about possible intervention. In fact, the U.S. currency touched a year-to-date high versus the yen after the BOJ said yesterday that it would be actually putting out some additional buying operations. So look out for anything on yen, 149.78. Treasuries, this is without a doubt the story of the week. We've seen some weakness in bond markets, and that, of course, has followed a slump in treasuries on Monday, where we had the hawkish Fed messaging starting to come back up, and then oil falling for a fourth day. Again, a lot of the macro concerns have been overshadowed by physical market tightness, and that's clouding the demand outlook. For the moment, you can see as the Brent 90.32. Now, joining us to talk about all of the markets and, of course, how we look at the week ahead is Grace Peters, EMEA Head of Investment Strategy at JP Morgan Private Bank. So good to see you,
Good
Grace.
morning.
Thank you so much
Lovely to be here.
for joining us. When you look at what the market is focused on, I mean, it's still interest rates, inflation. Actually, how much longer can these interest rates stay for, this high, if not higher?
Yes, absolutely. I mean, there's so many facets to this. I mean, it started, I think, with very much stronger growth in the near term, recession risks being pushed out, and obviously with stronger growth comes stronger inflation and higher rates. But I think the move that we've seen over the last couple of months is more than just the near-term recession. It's also about the structural makeup of the economy and the notion, which I think is now being endorsed by central banks as well, that actually the structure has changed. We've reached various tipping points when it comes to geopolitics, when it comes to the capex needs, that ultimately will push inflation and growth up over the longer term, and thus that move in rates has actually been more at the back end of the curve.
But Grace, I feel like this is the narrative from central banks for at least 2 or 3 quarters. It's just it takes a little bit longer for the market to catch up.
I think that's true, and I think you've also seen, on top of just the growth and inflation, i.e. the monetary policy mix within rates, you've also seen greater term premia reflective of that degree of uncertainty, and obviously increased treasury supply that we're also seeing coming through. So I think when we look at market pricing now, taking the US 10-year as an example, I think markets have caught up. We feel that quite a lot is now in the price, and so, prices can overshoot, but certainly relative to the fundamentals that we see, 10-year treasuries look 20, 30 basis points overvalued on the short term.
And Grace, this is what we heard from Loretta Mester yesterday on interest rates.
At this point, I suspect we may well need to raise the Fed funds rate once more this year and then hold it there for some time as we accumulate more information on economic developments and assess the effects of the tightening in financial conditions that has already occurred. But whether the Fed funds rate needs to go higher than its current level and for how long policy needs to remain restricted are really going to depend on how the economy evolves relative to the outlook.
And Grace, you've beautifully explained, some of the challenges that the world economy is facing. So how do you build a portfolio on the back of these challenges?
Yeah, so really, really important, because I think with this acknowledgement that we're not going back to an ultra-low inflation, ultra-low rate world, that has serious portfolio implications. So on one hand, you can say, well, fixed income yields are high, particularly at the front end of the curve with that inverted yield curve. That's very attractive. So fixed income, I think, can provide yield and protection against downside risks to growth. But we've been talking about upside risks to inflation, which is where fixed income is not going to help you in that tail risk scenario that Jamie's spoken about, where rates do move higher. And so that scenario really calls for more alternative assets, particularly real assets, infrastructure assets, even parts of the real estate market look pretty resilient to us. And so I think that combination of, call it a classic 60-40 equity and bond portfolio to drive returns over time, but really adding in the alternative assets is where we're looking to advise clients.
So great. I mean, a lot of certainly some of the real estate and private equity are over-leveraged. There's concern about commercial real estate. So how do you pick the good ones?
You do have to pick the good ones, because there's certainly parts of the real estate market that are in distress, particularly the office sector, particularly some of the large city offices in New York and the other large US cities. But there's also parts of the market that I think are still looking extremely solid when it comes to, sort of the inflation protection element. And also when we think about infrastructure, it's also feeding into a lot of these long-term trends that we're seeing, climate change, greater geopolitical risks, sort of some degree of supply chain reorientation. So I think that enabling infrastructure as well is also really interesting, that can play out in private as well as public markets.
So there's a great story on the Bloomberg terminal, which took quite a lot of people by surprise, but we've been talking about, this is BYD, and it's our big number of the day, and it's basically just about to surpass. I mean, it sells over 430,000 cars in the last 3 months, and this is the big number because it will continue, of course, course, putting pressure on Tesla. But there's so many of these, Chinese EV makers, Grace, and I don't know how you play that. So you have the geopolitics because it's China.
Yes.
But you also have the EV market where a lot of, for example, the Middle East are trying to be better at it.
So I think this is a classic example of, a part of the economy, a part of the world, the way we live, the way we consume, that's in structural change. And when we're thinking about, those upside risks to inflation, spending on climate mitigation and adaptation is one of the things that puts upside risk to inflation. But it's also a highly investable theme. And I think people used to think about thematic as investing as a bit of a sleeve. Are you a believer in thematic investing? I'll sort of, add that on. And I think this is just indicative of the fact that many of those themes are driving the economy, driving markets today, and actually can help hedge some of those risks. I think that transactions like this also, bring home the fact that there's a lot of cash out there, that generally corporate balance sheets are strong, and more M&A. We've seen the IPO pipeline opening up as well. All of that is, I think a bit of a positive tailwind for listed equities as well.
But Grace, overall, is it difficult to choose, if you look at the winners and losers in all of these thematic spaces, because of the geopolitics, because of the ever-changing world, how difficult is it to be certain what you're investing in?
I mean, these are global themes, so I think it supports, in our minds, the fact that global themes, you should have a global portfolio, for one. And obviously geopolitics, to some extent, sort of is definitely one of the risks that we have in markets, but it's also one of the opportunities. I do think you have to be more careful when it comes to stock picking, because there is a cost of capital out there in the market now, and cash is very competitive. And so it costs corporates more to do, M&A transactions or organic growth, and therefore I think in this world where there is a cost of capital alpha, the ability for managers to really be able to distinguish between the winners and losers is all the more important.
Grace, thank you so much. Grace Peters, the MEA Head of Investment Strategy at JP Morgan Private Bank, stays with us. We'll have plenty more, of course, on all of the AI stories that we've been touching on. Also, oil dropping on interest rates, worries despite a tight market. So we're live in Abu Dhabi at the ADIPEC conference, where oil and gas majors are gathered. We get the latest from the ground next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, key players from the world's oil and gas industry are at day 2 of the ADIPEC conference in Abu Dhabi, where Bloomberg Middle East and Africa anchor Youssef Gamaldin is also there. So, Youssef, good morning. I mean, it's all about the oil price. What's top of the agenda?
Well, that's a big debate. Is Brent crude, or WTI as well for that matter, down for a 4th straight day? Brent was briefly below $90 a barrel on speculation that, well, basically the Fed could hold rates higher for longer. That feeds into the crude oil trade and many other energy trades for that matter, because it's more expensive to ship crude and more expensive to store crude as well. ING put out a note in the last couple of hours, Fran, and they build on this argument. They're saying the repricing you're seeing today is not about fundamentals. But what is about fundamentals is what Citi points to, and this story got a lot of traction with our global audience. It's about demand getting weaker into the new year, and Citi making a call for $70 a barrel. Speaking of demand, the UAE energy minister weighed in on this issue, and here's what he had to say.
The last thing we want is to lose the demand. We as producers, we care a lot about that the price is right for the consumers. But right for the consumers for a very limited time is a very short sight.
So this was a wide-ranging panel discussion with the minister. They said that they're not targeting a price range, and they're still on track to expand capacity to about 5 million barrels per day by 2027. The JMMC meeting, which happens October 4, there's no expectation of any shift from any of the major players. But you know, OPEC Plus in the last 6 months, we've had plenty of surprises. So, you know, I would wait and see on that front as we continue to speak to a lot of the executives and oil officials here on the ground.
Yeah, they certainly have surprised us quite a bit. What about the role of non-OPEC countries?
Could you say that again? It is so busy here. I actually did not hear you.
I know it must be so. It must be so loud. I was asking about non-OPEC countries, Youssef. What role do they have to play? I mean, there's shale in the U.S., but there are also other countries that have that sit on huge reserves and that are not part of OPEC.
100%. Yeah, I think that you hit the nail on the head there, because the U.S. and Canada, they're adding quite a few more barrels. That's something that Dan Yergin, the global chairman from IHS, pointed to, global chairman of S&P Global, rather. And this is a story of new supply outstripping demand. It is something that I spoke to the Egyptian energy minister with just moments ago, and it's something I'm going to pick up with the Indian energy minister within the next hour, just to get a bit of an idea of what's happening on the consumer side of the story and how they're dealing with this energy price volatility, Fran.
Youssef, thank you so much. Youssef Gamaldin at the ADIPEC Energy Conference in Abu Dhabi. Now let's bring back Grace Peters-Zimier, Head of Investment Strategy at JP Morgan Private Bank. Grace, thank you so much for sticking around. First of all, when you look at oil, I mean, this underpins everything, and it's unclear. I mean, there's some calls from banks of it going back to $70.
Yeah, so we think oil will drift modestly lower from here, but I think what's really interesting is it links back to our earlier conversation around, you know, higher for longer and what's driving yields. So if we think about oil and the equity markets, both are pro-cyclical risk-on assets. So for the part of the stronger for longer that's linked to better growth, that's supported oil just as it supported equities going into the summer. When we start then to think about that risk premia that's come into markets, that's when we start to fear around, demand destruction, which has obviously led into fears in the equity market and fears in the oil market. So oil does feel, I mean, our year-end target's around $85 per barrel. As such, when we think about impacts to inflation, we're probably going to have a couple of months where inflation starts to sort of flatline, perhaps even headline tick up modestly. But we do still think then, as we go into early next year, that inflation will resume its downward trend.
But Grace, I guess underpinning all of this is the cost of credit.
Yes.
Right, and you get, is this the one thing more than inflation? If you get the cost of credit right, then you're going to be okay.
Yes, I think so. It's a tricky thing to get right because obviously everything is in the mix. But I think that is what the market is trying to figure out at the moment. You know, what is the right risk-free rate? What is the right cost of credit? and thus to price different asset classes off that, mindful of those two-way risks that we mentioned earlier to inflation and to growth in light of some of these structural changes taking place.
Grace, we also had the story today about the Bank of Japan and the fact that we were kind of on intervention watch, and for the moment nothing's happening, but certainly on tenterhooks, and they certainly surprised us in the last couple of months.
Yes.
Do you have an investment strategy for Japan?
Yeah, so Japan's a region that we're neutral overall. We do think ultimately inflation, wage inflation is building in Japan, as we've seen in other parts of the world. And at some point, policy normalization, does need to kick in the region. There are pockets of the Japanese equity markets linked to reopening, linked to structural change that we think are interesting. But overall, in aggregate, it's a part that we're neutral on.
I mean, currency, there's a lot of action in currencies. It seems in the last week or so. Is that going to be more volatile than other parts of the market?
Yes, I mean, currencies, I think, are very much, we tend to think about growth, rate differentials, and then fund flows. When we think about growth and interest rate differentials, that's definitely favouring the US at the moment, where you've got a Fed staying hawkish, whilst the ECB in aggregate, I think, are very much saying, the bar to further rate hikes is quite high, and so the ECB, I think, is on hold for a long while, but on hold nonetheless, versus this hawkish leaning from the Fed. When it comes to the fund flows piece, this is where actually I think Europe and Japan as well probably have got the more structural advantage. Coming out of negative rates, fund flows over the medium to long term should favour Europe, should favour Japan, which is where you start to tilt the balance. But I think the short-term momentum does lie with the dollar for the moment.
Where does it go in Europe? Because when you look at, again, the countries, a lot of them don't have a lot of fiscal space. Some of them will have pretty messy elections coming up.
Yes, I mean, when we think about across asset class basis, then, yields in Europe are not as high as in the US overall, so we do tend to prefer US fixed income in aggregate. But I think in Europe, you've got opportunities still at the front end of the curve, whether you're looking at euros or sterling as well. In terms of by geography, then I think there's a really interesting dynamic playing out at the moment. I know you were featuring Germany earlier in the program, so much driven by the manufacturing component. And when we break down PMIs, it's obviously manufacturing that's been weak for a long time. And we're starting to see signs that potentially that's bottoming out. So I think if that did, that would actually be a tailwind for Germany. But we like France, sort of as things stand at the moment. We do like its exposure to luxury goods, and we think that's got a good blend of sector exposure. And broadly, we're avoiding financials, which again aren't too prevalent in the French market.
Grace, it's been 19 minutes. We haven't even talked about the U.S. shutdown that was averted. Narrowly.
It was averted.
But also what happens in November.
The can was kicked down the road, should we say. Well, I think, look, it certainly we don't have a long-term plan yet. And when we think about, debt sustainability, it's an issue. It's an issue that feeds into that term premia part of the yield conversation that we had. And I think it does also feed into FX to some example. We still do think that the dollar is going to very much remain, the reserve currency of choice. But gold does start to play a greater role when we start to think about, sort of movement of capital, thinking about the portfolio in the context of everything we've discussed, but also when we think about, the US fiscal deficit and those high debt levels that need to get sorted rather than just, postponed.
Pushed back. Grace, thank you so much, as always. Grace Peters there, EMEA, Head of Investment Strategy at JP Morgan Private Bank. Now, plenty more to come, including, of course, we go to the UK Conservative Party conference. We'll have plenty more also of our exclusive interview with the JP Morgan Chief Executive, Jamie Dimon. That's coming up shortly, and this is Bloomberg.
in 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now let's get up to speed with some of the other top stories on the Bloomberg terminal. And a Bloomberg News investigation has learned that several Taiwanese technology companies are helping Huawei build infrastructure for an under-the-radar network of chip plants across southern China. Now staff from subsidiaries of Taiwanese chip material reseller Topco Scientific and LNK Engineering were present at the construction site in Shenzhen. It's unclear whether the company's potential involvement violates American sanctions. Well, Bloomberg has approached them for comment. And Republican Congressman Matt Gaetz has officially moved to topple U.S. House Speaker Kevin McCarthy. It sets up a high-stakes vote in a process that has not resulted in a speaker being removed since 1910. Now, McCarthy's embrace of a bipartisan deal to avert a government shutdown triggered the call from the far-right Republican. The House Speaker must call a vote within 2 legislative days. And New York prosecutors say former President Donald Trump overvalued his properties to get cheaper financing and rise up the Forbes billionaires list. Now, Trump attended the start of his civil fraud trial yesterday as the state presented its opening statement. Trump's defense team argues that the claims involve only successful and profitable loan transactions with no vixens. BYD is poised to overtake Tesla as the world's biggest seller of electric vehicles as the Chinese automaker's global sales push gains greater traction. Now, China's best-selling car brand came within a whisker of toppling Tesla last quarter after factory downtime led to the U.S. company's first delivery decline in more than a year. Well, BYD sold more than 431,000 fully electric vehicles in the latest 3 months, up 23% from the previous quarter. Tesla shipped 435,000 over the same period. What's interesting is that BYD only has a market share of around 0.3% of the European automaking sector. Now, Boohoo Group shares have slumped to an 8-year low. That's after the UK fast fashion online retailer cut its earnings and revenue forecast as it lowered prices to attract cash-strapped shoppers. You can see Boohoo down 8.4%. Coming up, a highly anticipated rail infrastructure project under threat. What does it mean for the UK government's levelling up agenda? We're live at the Conservative Party conference next, and this is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
European equities and U.S. futures drop as Cleveland Fed President Loretta Mester says the U.S. may need to raise rates once more this year and hold them at higher levels for some time. Oil falls for a fourth straight day as rate fears overshadow physical tightness in the market. Plus, the J.P. Morgan chief executive Jamie Dimon says AI will allow some people to work 3.5 days a week. We'll bring you more from our exclusive interview. Now, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. The J.P. Morgan chief executive Jamie Dimon is warning clients and investors to prepare for a worst-case scenario of interest rates at 7%. Well, he spoke to Emily Chang exclusively on the sidelines of the J.P. Morgan Techstars Leadership Forum in London.
Can it go to 7%? The answer is yes. Are there factors that would drive it, higher than, where it is today? 4.5, 4.6, or 4.7, over the 10-year bond now. Yes. Is supply and demand could push out? Yes. I'm just saying, be prepared for it.
So,
and then the worst case is stagflation. Higher rates because you have a booming economy and there's a lot of competition for capital is not the same thing as stagflation.
what are the ripple effects of the stress of that 7% rates on business, on your growth?
Well, I'm not worried about J.P. Morgan. J.P. Morgan, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too. That risk management is not the same thing as guessing the future. When risk management, look at the range of potential outcomes and being able to say to yourself, we can handle this, we can handle this, we don't really expect it, and we can handle the in-between. If you bet your company on one outcome, so I think all companies do that. And every company's got different exposures. Input prices, output prices. Some interest rates don't matter. Some it's the price of mozzarella. So what's your business? Your business is different. So, but I think we don't know the effect of these things on the economy. So we may have a soft landing. We may have a mild recession. We may have a harder recession. Obviously there are potential bad outcomes. The worst one would be economically is stagflation,
right?
Where you have low growth, high interest rates, and obviously if that happens, you're going to see a lot of people struggling.
Regulators have proposed new capital rules that banks have said will make it tougher for Americans to get a mortgage. But I'm curious, when you look across the firm, what businesses are going to have the biggest impact?
When you get into the specifics, it really matters how the ultimate rules about mortgages and small business loans, et cetera. In general, it makes, what I don't like about it, for example, it punishes diversification, operating risk capital, and GSIFI. And diversification is one of the true free lunches for a bank that protects it. And I don't understand why they do that. And I just, we're going to be responding. Hopefully it'll be modified. And and thoughtfully done for international purposes. And mostly, America's got the best financial system the world's ever seen. And, that includes hedge funds and private equity and private capital, all things like that. But this is, I say the private equity hedge funds are dancing in the streets. And this time they're being quite public about it, because this is going to push a lot of stuff out of the banking system. And if that's what the regulators want, so be it. Is that good for America? I don't know.
JP Morgan Chief Executive there, Jamie Dimon, speaking to us exclusively. Now, the UK Conservative Party conference is underway in Manchester. Bloomberg's Caroline Hepker joins us from there with the guest. Caroline.
Good morning, Francine. Thank you so much. So, to give you the background here at Manchester Conservative Party Conference, the annual gathering, the Prime Minister is under fire for not making a decision about high-speed rail 2. This is a multi-billion-pound rail project that is meant to bring high-speed rail right here to the city of Manchester. He says he doesn't want to make a premature decision, but there is a cabinet meeting taking place today about that. The other issue is around tax cuts. The Chancellor and the Prime Minister have refused to make any pledges or commitments on tax cuts, including in the Chancellor's speech yesterday. But the other big event here in Manchester was the former Prime Minister Liz Truss. Undaunted by her short and pretty disastrous tenure last year, she addressed a packed room of Conservatives just over the road yesterday, making big promises. Make Britain grow again was her tagline. She also talked about the need to build 500,000 homes in the UK. That really is a staggering figure. Joining me now to discuss this and what is happening at Conservative Conference is Rachel Maclean, who is the UK's Housing Minister.
Hello.
Good morning. Thank you so much for your time and for joining us. Liz Truss advocating for 500,000 homes to be built in Britain. OK, admittedly, she's not in government, but the Liberal Democrats want 400,000 new homes to be built. There are big ambitions. What do the Conservatives want to do?
Yes, I mean, look, where I completely agree with Liz is we just need to build more bloody houses, as I think the young Liberals have said. So as Housing Minister, that's my job. I'm getting on with doing that. We've actually had a pretty good record of house building over the last 5 years under this Conservative government. There are some things we are getting right on this agenda, but there's obviously a lot more to do, and that's what we're focused on. We're in the middle of taking some long-term decisions about housing in places like London, Cambridge and Leeds, talking about how we're actually going to, over the long term, grow those places to make sure we've got enough housing for people.
OK. Is there a bit of amnesia at this conference? The Conservatives scrapped a target of 300,000 homes to be built a year because it was unachievable.
No, we didn't. No, we've never scrapped the housing targets. We still have housing targets of 300,000 homes a year. And if you look at our delivery, we've actually got the highest house building on record in the last 5 years compared to the last 30 years of housing delivery. As I said, there's more to do, but it's completely wrong to say we've scrapped housing targets. We still have those targets, and we're getting on and building those homes.
OK, and just to confirm, also we're getting on the Bloomberg terminal this morning, confirmation now that the Prime Minister, Rishi Sunak, is going to hold that cabinet meeting today to make a decision about HS2, the rail project. I mean, this has fissured the Conservative Party, whether, even the Conservative Mayor of the West Midlands, Andy Street, says that backing out of this, it's a once-in-a-generation opportunity and it's missing a key target on levelling up if it is not delivered. If the Prime Minister decides to back out of levelling up, that's a disaster for Britain, isn't it?
Well, I don't think you should really frame this as backing out of levelling up. It's not, to be clear. This is one project that was started a long time ago under a different government. Since that time, we have ambitious levelling up projects all over the entire country. We've delivered free ports, we've delivered investment zones in my own portfolio, we've delivered levelling up partnerships. Towns Fund just this week announced £1 billion going to a number of different towns across the country to regenerate their high streets and their town centres. And look, I think the Prime Minister is right, to be honest, with the British public about the cost of HS2. It has spiralled. When I talk to my constituents in Redditch, what they want is decent bus services. They want trains to Birmingham. They want to be able to get around the region. So we obviously have to look at this through the lens of a tight public spending settlement.
Look, it is confirmed now that HS2 has now been scrapped, the leg to Manchester.
Have you just heard that?
Just heard that. I've just been told.
Coming in, is it?
So
right,
you're getting the news as I am.
Okay.
OK, waiting. Okay, awaiting confirmation then in terms of HS2. All right, so we know that there's a cabinet meeting, so we're waiting to understand and get some clarity on this issue. All right, listen, returning to the housing portfolio, your portfolio, the crisis in the rental market, spiralling costs. You've got 3 times the pace of inflation in terms of rental increases in Britain. Again, how does the Conservative government address this pressing issue?
It goes back to what I said in answer to your first question. The way we address this crisis is by building more houses of every type. We have a mismatch of supply and demand. We've got very high levels of immigration, both legal and illegal, to this country. We've got demand spiralling for housing. I mean, when you talk about immigration, housing doesn't discriminate between someone who comes here illegally or if they come here legally, for example, because they still need a roof over their head. So all of that is putting pressure on the houses that we need to give homes to people, our own people who've lived here all their lives, and of course other people as well, and new households that are forming. So we have high demand. So the way that we deal with that is we build more houses, and across the piece we then have more houses for people to rent, more houses that are affordable, and we're investing in social housing at the same time.
I'm pressed for time. I want to jump in. The Renters Reform Bill that has been pushed off, it's meant to protect tenants so that they are enabled to stay in their homes for longer, effectively. Michael Gove denies that there is any delay. Is it actually going to be put forward? It's going to be in the King's Speech next month?
Well, I'm very proud of this legislation. It's already been introduced into Parliament. We've all stood on a manifesto commitment to abolish that Section 21, which is what you're talking about. Yes. That's the no-fault eviction clause, which we know is a leading cause of homelessness. We will bring that bill forward, hopefully very, very soon, because it's important that we deliver on that promise to young people.
But not in the King's Speech next month?
Well, obviously, only the King knows what's in the King's Speech. It will be brought forward as soon as parliamentary time allows, and I'm pretty optimistic that will be brought forward very soon.
And in terms of, there is a crunch going on in terms of trying to fix the housing market in Britain. Prices are falling, but affordability measures are actually strained. What are you going to be able to do about it, other than a very, very long-term measure of building more homes?
Well, we have to take those long-term decisions now. It's right that we're doing that. And when we do that, there will be some people who are upset with that. You can't please all the people all the time, specifically not in this housing brief. So we do have to build houses. We have to build them in the right place. But if you look, you talk about affordability and pressures on people's budgets, and we really do know that the cost of living is impacting people. But that is why the government has put billions of pounds of support into cost of living packages, helpful energy bills. And it's also why the Prime Minister is so focused on getting inflation down, because it's those costs that are eating into people's budgets and really putting pressure on their ability to afford mortgages or rent. So we need to carry on with that plan and make sure that we do get inflation down.
Rachel McLean, the UK Housing Minister, thank you so much for joining us here on Bloomberg Television. Francine, so we do know now at Conservative Conference that there is going to be a cabinet meeting, and we do expect more decisions now on HS2, but the question over building more homes, over whether there'll be more tax cuts from this government as we head into a general election pretty soon, those are still question marks, Fran.
What a great interview. Caroline Hebker there from the UK Conservative Party conference in Manchester. Now, on to UK retail, and Sharon White plans to step down as chair of John Lewis Partnership after struggling to turn around the beleaguered UK department store chain. Well, White has been trying to return employee-owned John Lewis to profitability following the pandemic and the cost of living crisis. Let's talk more now with Bloomberg's Sabah Meddings. Sabah, first of all, congratulations on all of your reporting. So you cover UK retail, and it's, you know, a lot of the high street, I guess, at the moment is in crisis. John Lewis is a slightly different business, but with the chair stepping down, it's really important to put focus on why it's been so difficult to turn this company around.
I think John Lewis, sort of separate from most businesses in UK retail, it's owned by its employees and always has been. So unlike others that may pay dividends out to shareholders, John Lewis has always paid its profits to its employees. But the trouble is, John Lewis has a big store footprint. Sharon White came in at a time when she faced COVID. Her job was to kind of try and pivot that business to online retail. She took some tough decisions with closing stores, but ultimately John Lewis has to make some difficult decisions. And when the partners own the business, it's very difficult to take those drastic measures it may need.
So what does it need? I mean, is this a lease problem? They also have Waitrose. So is it the way that it's run, or they're just not selling enough?
I think, well, Sharon White came in and she made this promise that she wanted to make more and more of the revenues from outside retail. So you had a kind of a non-retailer coming in saying, you know, she wanted to perhaps make money from rental homes. She did a partnership with Aberdeen. There was a deal with Ocado, which is no longer. So John Lewis needs to raise money. It's thought about doing some sale and leasebacks with some of its Waitrose stores, some of the more desirable ones. But ultimately, John Lewis has this sort of never knowingly undersold. You know, it's famed for its customer service, but it does seem to have lost focus on perhaps its core retail, and that's really the problem we're in today.
Yeah, I mean, I feel when you're middle-aged, you start liking John Lewis. There's also this, other iconic brand, Dr. Martens, and they're opening a huge storefront in the UK on Oxford Street.
Oxford Street. I mean, who wouldn't want to be on Oxford Street? It's one of London's prime shopping destinations. But definitely, Dr. Martens coming in is a real show of confidence in that street, which has been a little beleaguered of late. We've had Topshop, we've had BHS, we've had House of Fraser, Debenhams have all left empty spaces on that street. So for Dr. Martens to come in, we've got IKEA coming in as well. It is a show of confidence. But we do know there is money to rejuvenate the site, and as part of that, they've been giving quite generous rental deals. So whatever Dr. Martens may have been offered, we don't know, but potentially there's been some kind of incentive to go there as well.
So interesting, Saba. Thank you so much. Sabah Meddings there with the very latest on the health of the UK high street. Coming up, as Sam Bankman-Fried's FTX crypto trial begins in the US, we also take a look at the timeline of how we got here. That's next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, almost a year after the collapse of the crypto exchange FTX, its founder, Sam Bankman-Fried, is about to face trial in New York. The 31-year-old has pleaded not guilty to 7 counts of fraud and conspiracy. Well, Bloomberg's Katie Lyons looks at the rise and fall of one of the biggest names in crypto.
Thank you, guys. In the span of 3 years, Sam Bankman-Fried became one of crypto's biggest stars. In May 2019, Bankman-Fried and business partner Gary Wang founded FTX. Its goal? To create a safe and responsible platform for traders. By October 2021, venture capitalists had poured millions into FTX, and A-list celebrities like former NBA player Shaquille O'Neal, model Gisele Bündchen, and comedian Larry David had endorsed it. That same year, the firm was valued at $25 billion, and users soared to more than 5 million globally, at least 1.2 million of them in the U.S. The FTX name became well-known, appearing on T-shirts, in commercials, and even on an NBA arena. By early 2022, the Bahamas-based company's valuation skyrocketed to $32 billion. FTX had become one of the world's biggest crypto exchanges. Bankman-Fried's net worth climbed to $26 billion, and he said he wanted to do good with his money, following effective altruism.
I both think it's not what I should do with my money. I think I should be thinking about how I can help the world with it.
The then 30-year-old also became a major political donor. He contributed tens of millions to bipartisan political action committees and frequented Capitol Hill to be a voice for his company and the industry. At the time, he had no plans to slow down.
I'm going to be here for the long term. I have no plans to leave. That is not something that is on my horizon.
But in November of 2022, things began to unravel. CoinDesk reported that the crypto hedge fund Bankman-Fried had also founded, Alameda Research, had a significant portion of its assets made up of FTT, a token that FTX created. In response, on November 6th, CZ, the CEO of rival crypto exchange Binance, posted to social media saying, quote, "We have decided to liquidate any remaining FTT on our books." The move triggered a massive wave of withdrawals, sort of like a run on the bank, and FTX didn't have the funds to meet them. In a rescue attempt, FTX reached a deal with Binance to sell itself, but Binance backed out.
It became very quickly, there was a lot of funds missing, like up to the tunes of, double-digit billings. I couldn't trust any of the information in the data room.
So by November 11th, it was over. FTX filed for bankruptcy and Bankman-Fried resigned as CEO. That same month, he apologized at a public event.
I made a lot of mistakes or things I would give anything to be able to do over again. I didn't ever try to commit fraud on anyone.
But just a few weeks later, Sam Bankman-Fried was indicted, accused of misappropriating billions of dollars at the cryptocurrency exchange.
It's fair to say that by anyone's lights, this is one of the biggest financial frauds in American history.
Kaylee Lines there with the story of the FTX and Sam Bankman-Fried saga so far. Now, coming up, Sequoia Capital's Rolf Botha spoke to Bloomberg about the AI frenzy. That's coming up next, and this is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Very active seed investments. 60% of our investments over the last 12 months have been in around AI. Now, I was in Silicon Valley in the late 90s, and there was a lot of hype around the internet. And we went through a trough of disillusionment at some point around 2002. And I think in the long run, the internet was far more profound than we could have imagined at the time. I think the same may be true for AI.
Of Sequoia Capital managing partner and steward Roloff Botha, they're speaking to Emily Chang about the AI frenzy. Now, while investors have piled into AI bets this year, Wall Street has also been slower to succumb to the new technology. Computers have struggled to decipher noisy markets, but there are signs that this is shifting. Now, for more, let's bring in Bloomberg's cross-asset reporter and author of today's Big Take, Justina Lee. So, Justina, first of all, congratulations on a wonderful Big Take. Really interesting, and it's amazing to see the advancement of AI technologies in certain industries, and you kind of take stock of what it means for Wall Street. So is it tougher or easier for Wall Street to take advantage?
So Wall Street uses a lot of the productivity hacks that we're all really excited about. I mean, when I spoke to hedge funds earlier this year, they're using ChatGPT to summarize research, write code. But I think, the holy grail in finance is always to use machine learning to kind of predict markets and decide what to trade based on that. And I think that is, a lot of people are finding, much harder than even, teaching ChatGPT how to write Shakespeare.
So how does it, if it's harder to apply, to AI, to finance, where does it go? Is it more algorithms that they need to work on?
Well, a lot of hedge funds are saying that they're still trying to crack this puzzle, and they're making a lot of progress. I think what they're finding is you need to fine-tune a lot of these methods coming from Silicon Valley to financial data, which is a lot noisier, and it can change from one regime to the other. And you actually don't have as much data as you have in, photos of cats and dogs, for instance, right? Because you can't just, generate new days of trading data. And so I think a lot of hedge funds are trying to work within those limits and trying to see how can we adapt those techniques to what we do here.
So could it at some point pick stocks for me? Is it easier to kind of look at balance sheets rather than talk about the treasury market?
I think it can possibly pick stocks for you with less manpower than before. Because so far, the track record of a lot of AI-powered hedge funds is not spectacular, but it's sort of roughly the same as a lot of human-run funds. And I've spoken to some investors who say, maybe that's good enough. But I think a lot of people are finding a lot of the AI tools are really helpful. For instance, one thing that everyone likes to do these days is using something called natural language processing to read tweets or read the news and turn that into trading signals without a human ever having to read a word.
Okay, amazing. Justina, thank you so much. Justina Lee there with today's Big Take. I urge everyone to go and read it. If you have a Bloomberg terminal, just go into NI, Big Take Go, or we'll also push it out on all of our social media platforms. Now, let's also take a look at some of the events that we're looking out for today. 1 p.m. UK time, we'll hear from the Atlanta Fed President, Raphael Bostic, who's participating at a roundtable discussion. 3 p.m. London time, the key data drop of the week. We'll get the monthly U.S. job opening numbers from the Labor Department. And then throughout today, we're expecting a number of ECB speakers, including Philip Lane, François Villeroy de Gallo as well. And then 3 p.m. UK time, Bridgewater Associates founder Ray Dalio will also be speaking at the Greenwich Economic Forum in Connecticut. So up next, a Bloomberg Brief with Danny Berger and Manus Cranny.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
This is Daybreak Europe. I'm Kriti Gupta. And let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
A chorus of hawkish Fed comments dislocates the bonds. Loretta Mester suggests rates may be higher for longer.
At this point, I suspect we may well need to raise the Fed funds rate once more this year and then hold it there for some time as we accumulate more information on economic developments and assess the effects of the tightening in financial conditions that has already occurred.
Meanwhile, in Australia, the Aussie slides as the RBA keeps rates unchanged, but says some further tightening may be required. And Kevin McCarthy's job is on the line. Fellow Republican Matt Gaetz officially moved to topple the House Speaker, teeing up a vote that may shift Washington's balance of power. Very good morning. The balance of power is still with the bond vigilantes, that's for sure. But it almost feels as if the ligature which is around the bond market over the past 5 days has loosened ever so slightly. Yields come off their zenith, the 2007 high for the 10-year paper. ING this morning said the pushback by the Fed and those voices that you hear in the past 24 hours is against that rate protest that you have. The market is not keeping up with where the Fed want you to be. Now, the euro trashed and crashed yesterday by nearly 1% as the musculature of the dollar was really felt. Higher rates, higher dollar, and that momentum was there. Is there a disconnection from reality in the bond market as far as the euro is concerned? Nomura said yesterday on surveillance, it feels like we should be at 101 to 103 already. Philip Lane comes out this morning, the chief economist, and says there is more work to be done. It's going to be hard to sustain lower gas prices. So we see this small inflection and move higher in the euro. The oil market is flat at the moment, but you can see we're just in the midst of trying to decide. We were down for 4 days in a row. We dipped below this $90 level on the yield spike and the dollar dislocation. It feels as if, or it felt as if, some of these markets were at a breaking point. Citi's Ed Moore says $70 is a possible price on the oil market. As Mazrui at ADIPEC, the UAE oil minister, says we're in the right place for OPEC policy. Danny.
Man, it's just when you think you've wrapped your head around oil, another twist and turn in that narrative with it dropping below 90. The other debate we're having in this equity market, Manish, is do we care about higher rates? Can equities charge higher, even if we're talking about 10-year yields at 4.7%? MSCI Asia Pacific, not so a tough session. China's off the map. It is Golden Week for the Chinese equity market for the region. Still, we're trading at the lowest level of this year for the MSCI Asia Pacific. We're down 30% from the top. Morgan Stanley says global funds have cut their China exposure to the lowest since 2020. Now, for the rest of this equity market, Europe claws back from a negative day yesterday. Just barely, though. I mean, we're basically unchanged. And S&P 500 futures, they're higher after ending higher yesterday. But, man, this is the divide. It's really well encapsulated by Bank of America and Morgan Stanley. So Vita Subramanian over at Bank of America says that, yes, we can move higher even if rates are higher for longer. But Mike Wilson, who's always bearish over at Morgan Stanley, says, no, like me on a bad day, stocks have had a change in personality, a distinct change of personality is what he calls it. And they care about rates, Manus.
There's no schizophrenia on this show. Absolutely not. We're two very well-centered people at 3 a.m. in the morning when I come in here. Look, the debate is this, is what price do bonds need to go to clear the upcoming supply? We'll talk about that with Moko Papik in a moment. But we both struck by what Ed Yudani had to say, and this was it. The man who christened bond vigilantes that we've quoted so often. The worry is that the escalating federal budget deficit will create more supply of bonds than demand can meet, requiring higher yields to clear the market. That worry has been the bond vigilantes' entrance cue. Now, that is not the view of our bond guest in 45 minutes from Clock Tower, but that is Yudani laying out the roadmap. Danny.
Yeah, and I love what he continues to say that, is this on the Fed's radar, Manus? If higher yields aren't yet on the Fed radar, then they should be.
Exactly, and that's the concern about the constriction of FCON. Let's take those thoughts to our guest host this morning. It is Remy Olupitan, fund manager over at Schroders. Remy, good to see you this morning. Should the Fed now be worried about this? It almost feels as if, as JP Morgan say, the bond market has become dislocated from its typical drivers. Is it showing signs of dislocation to you? Good morning.
Good morning, Manus. Not at the moment, because actually we think that this is what the Fed wants. What we need to be careful of is the speed and the level, but I do think a slight increase in bond yields is consistent with what the Fed is trying to do. They've made it quite clear that further rate hikes are still on the table and that yields will be higher for longer. And as a consequence, the 10-year was quite dislocated and really was struggling to accept that. Yeah. And I think what we have seen is some acceptance.
Yeah, I mean, it's a great point because we've been saying for how long the bond market hasn't woken up to higher for longer. Now that it has, we're all of a sudden all freaking out that it's woken up. So tell me, when should I freak out, Remy? At what level do I get worried?
To be brutally honest, we think that it's starting to look quite attractive now at 4.7, but there's always risk of mistakes. And typically with markets, things do overshoot. The 5% level is quite a scary level. We also need to focus on real yields because that is where you're getting the transmission. I mean, there has been some concern that monetary tightening hasn't been transmitting into the US economy. Now that we're seeing long-dated bond yields rise and real yields rise, I think that's coming through. So 5% is a number to be wary of, and 2.5 on the US 10-year real yield is a number to be wary of as well.
Okay, so you've put your stake very clearly down, 2.5% on the real yield. What would that do to tech? And the reason why I ask you that, Danny, myself, and the team have been looking at some of the balance sheets, and a big shout out to Dan Curtis on this, the balance sheets within tech. If you look at the cash that Meta has, $53 billion, Apple has $167 billion. With real rates going to 2.5%, which is a risk, as you say, in the market, do these balance sheets bolster against that real rate at 2.5%? Is that enough to bolster big tech?
We think that that's enough to bolster big tech. I mean, these balance sheets are in a very strong position. Nevertheless, there's an issue with regards to the price and what is the right price. And I think that that's the debate markets a lot of investors are having, because with higher real yields, there's that opportunity cost, the valuation debate. I think that that's what's causing this temporary headwind for tech. Once we get through that, investors will start to focus on the fundamentals. A lot of these companies are in a very strong position, but there are a lot of weak hands, not in tech, but in other sectors.
Can I also show you something else that's a little bit puzzling for me. Perhaps on the other side of things are junk spreads right now. I mean, they've tightened significantly this year despite everything, banking crisis, what have you. Triple Cs are at 848 basis points. Prior recessions, they're usually around 2,000. Should we be bracing for something much worse in this junk market?
Yeah, that is puzzling. I mean, there are two things that we have to recognize with regards to junk spreads at the moment. Again, similar to the argument on tech, a lot of these companies are in a strong position. I mean, they really benefited from very low rates for many, many years, and they were able to really sort out their balance sheets and extend the term of their financing. So just starting from the starting point, they're in a strong position. We do have a wall of issuance coming towards the end of next year, early 2025, so that will cause some tantrums, and there should be some widening of spreads. But a lot of investors are looking at the absolute yields. And at the moment, those absolute yields are really attractive, specifically relative to everything else you can own. And so I think that is driving some demand.
And that is the conundrum, isn't it? Whether you want to take high-grade credit, let's say, with less volatility than equity. With that in mind, where does credit sit for you?
So we have been nervous about credit, particularly high grade, for part of the reasons you've mentioned, but also the duration, because we think that the volatility has changed. A lot of the high grade, high quality investment grade credit, particularly in the US, you're looking at a duration of 7 to 8 years. So actually what you are trading is nominal bonds with a little bit of a spread. So a lot of the performance has been driven by the volatility in rates. So you're not really getting that corporate fundamental benefits that you want. And I think that that's one of the reasons why high yield bonds have performed quite well, because they have less duration sensitivity. And as long as we feel that the US economy will remain resilient for a bit longer, these bonds can outperform.
How much of that is tied to energy, too? A lot of these companies are obviously energy companies, too, and oil prices flirting with $100 a barrel.
That is fair. That is fair. I think you're right in that the composition of some of these, of the credit universe has changed, and you do have a lot of sectors, particularly within energy, that are in a very strong position. They are seeing an increase in their share prices, and that gives a lot of investors some confidence. I think what we have right now is, again, about this debate with higher bond yields and how we as investors need to accept this and deal with the reality of the next couple of years. I mean, even if we do see bond yields coming back, I doubt whether we're going to see the 1s and 2% that we were used to many, many years ago. And so we do have to be more discerning. The way we look at asset classes has to change, and there are some interesting assets that can survive this.
Yeah, a new regime, but I mean, one we can live with, one we can definitely find opportunities in. Remy?
I don't think we have a choice.
Very well put. Remy, I'm afraid that's all we have time for. Thanks so much for joining. That's Remy Olupitan of Schroders. Now, here's some other stories, some top stories that we are tracking this morning. JP Morgan CEO Jamie Dimon says artificial intelligence is already being used by thousands of employees at his bank and is likely to make dramatic improvements in the workers' quality of life, even if it eliminates some jobs. He spoke exclusively with Bloomberg yesterday.
Technology's always replace jobs. Your children will live to 100 and not have cancer because of technology. And literally, they'll probably be working 3.5 days a week. So technology's done unbelievable things for mankind. But, you know, planes crash, pharmaceuticals get misused. There are negatives. This one, the biggest negative in my view, is AI being used by bad people to do bad things.
And another Bloomberg scoop, Taiwanese companies are helping Huawei build infrastructure for a secret network of chip plants across southern China at a time when China threatens Taiwan regularly with military action. The island's tech companies may be helping US-sanctioned Huawei develop chips to effectively break the American blockade.
I mean, as elsewhere in Asia, Evergrande soared as a return from a trading halt, driven by what appears to be bets on a penny stock, even as the developer's fate hangs in the balance amid an official probe into its billionaire founder, Manus.
Okay, coming up, it is Gates versus McCarthy. As a Republican congressman officially moves to remove the House Speaker, could the balance of power be shifted? Plus, oil falls for a fourth straight day. We're live to ADIPEC Energy Conference in Abu Dhabi with India's oil minister right here on Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
Well, I think the American people deserve to know the coalition that really governs them. And Kevin McCarthy likes to pretend that he makes coalition with conservatives, but all he really does is break his word with conservatives. The coalition that really runs this country is the Uniparty. It is the Biden, McCarthy, Jeffries government, and that is what we will demonstrate with this vote.
That was Representative Republican Matt Gaetz speaking to reporters after he officially moved to topple House Speaker Kevin McCarthy last night. Now, all of this sets up a high-stakes vote in a process that hasn't resulted in a speaker being removed since 1910. Joining us now is Bloomberg senior editor Bill Ferries on this. Bill, of course, has extensive experience covering U.S. politics for Bloomberg, so no one we'd rather speak with. Bill, given how long it took McCarthy to become speakers, it was 15 rounds of voting. I remember we talked extensively about it at the time. How big of a surprise is this?
Well, it's not a surprise at all in the sense that there was a kind of a devil's bargain that Kevin McCarthy made to get elected on that final 15th round of voting, and that was to give one member of Congress. Any single member could have the power to essentially call for a no-confidence vote in his leadership. It's 435 members of Congress. The Republicans have just a narrow majority. There was always this kind of wild, hard-to-control right-wing group that was never crazy about McCarthy to begin with, and was really chomping at the bit to have a reason to go after him. Matt Gaetz is taking that step this week. We'll have to see how it plays out, but it's something that Kevin McCarthy knew from day one in his speakership was always likely to happen.
So this could all come down to what kind of support the Democrats are prepared to give to McCarthy. Look, if you step back from this, what is Congressman Gaetz doing, and what are the chances are that he will be able to pull this off? Do you think the Democrats will extract some concessions to get behind McCarthy? What's the feeling on the Hill at the moment?
It's there's a whole lot of different scenarios, different ways this could play out. As you said, you know, with the narrow majority Republicans have, if Matt Gaetz can get 5 other members of the Republican side to join with him and all of the Democrats, that could be all they need to oust McCarthy. I don't know if the Democrats really want to go down that path. They could also, as a bloc, sit out the entire vote. That would leave, you know, if McCarthy just needs a majority of those voting to stay in power, he would have still the majority of his own party backing him, because this is really a minority that's looking to get rid of him. What is Gates doing? He has said he wants to lay the groundwork for a potential President Trump return to the White House. And he wants to go after Republicans he doesn't think are willing to fight hard enough. That's part of his strategy. And also, he has just found this to be a good fundraising mechanism. He has sent out emails trying to fundraise off of his efforts to oust the speaker.
So what's the timeline for this then, Bill? What happens next? What is the process?
Well, under the House rules, they have to have this vote that Gates is calling for within 2 legislative days. You can extend that out quite a bit. 1 legislative day could just go on endlessly as long as they don't conclude it. But it does seem like Kevin McCarthy wants to get this over with. He said, bring it on. I'm ready to face this. He could call for it as soon as today in Washington. Certainly by Wednesday in Washington, we could know the results or have a good sense of where this is going.
Okay, it's going to go down to the wire, isn't it? It's going to be interesting to see just where the Democrats come down on this bill and whether they do sit it out completely, as you say, and just leave it to the Republicans to deal with their own in-house laundry, so to speak. Bill Ferry's on the very latest from Capitol Hill. Quick check on the markets this morning. That level of deep concern that something might break just seems to have paused. Equities are up by 1/8% at the moment. The dollar is still strong. It had a mighty day yesterday. Yields just tip a little bit higher now. 468 is where we are. And crude, Mazrui from the ADIPEC conference, the UAE oil minister says we're in the right place. That's the state of play on markets right here on Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Krani in New York. Now, Birkenstock is looking to raise as much as $1.6 billion from its IPO. Accompanying filing says the German footwear maker will sell shares in a range of $44 to $49. That would value Birkenstock at over $10 billion at the top end of the range. The filing says investors include the Norwegian Sovereign Wealth Fund and T. Rowe Price are interested in buying shares. Manis, I just want to know, when are my Dior Birkenstocks coming in the mail? When are you sending them over to me?
Listen, I know you're always trying to sort of say to me, now that I'm earning US dollars, I'm going to be able to be generous towards you. All I've got to say, so we've both, you know, it's interesting on this show. I look at normal Birkenstocks. What were you looking at? Dior Birkenstocks. So I had to look at the men's. $1,000 for a pair of men's Dior Birkenstocks to go to the beach. Are you having a laugh? I mean, maybe, but then you said to me it's a lifestyle thing.
They're not just shoes.
What?
Yes, they're not just shoes. It's a lifestyle. Imagine yourself on the beaches of the south of France wearing your Dior Birkenstocks. It feels right.
Let me tell you this. I've done a lot of the south of France. I've done a lot of Saint-Tropez. And I tell you what, I didn't do them in $1,000 shoes. I'll wait to see you in your Birkenstocks when you make it to here. But should we talk about, let's talk about Taylor Swift, shall we? I mean, the power of this woman, never mind her music and her record sales. We're now football. The economic impact, it's in the NFL. The TV ratings, they've just had a massive bump, an increase in the money bet on the games amid the excitement, of course, with her relationship, or her speculated relationship, with the Kansas City's Travis Kelce. So, would you watch more football because Taylor Swift is there? Would you? Come on, tell the truth.
No, but I honestly, I wouldn't. I'm not the biggest football fan or Taylor Swift fan, but you literally can't avoid it, Manis. It is everywhere on Instagram. It is literally everywhere. But here's my fun fact from last quarter, the third quarter. Taylor Swift, Beyonce, and Barbenheimer all together added $8.5 billion to growth in the third quarter. She is single-handedly, her and Beyonce are supporting this American economy.
Well, I tell you what, there's a few jobs that got added in the temporary side with all of those things. I mean, some of the facts on this Taylor Swift story. Pulling in 2 million additional female fans to the network. So the audience, NBC Sunday Night Football drew an audience of 27 million viewers. That is up 22% on last year. And 2 million more women watched. And the betting on, by the way, his jersey sales are up 400%. He can afford these. He can afford the Birkenstocks at $1,000, can't he?
I love that. Taylor Swift, let's be honest, is the breadwinner in that relationship, but she's doing so much for his career. She's doing so much for the NFL.
So much for the American
supporting
economy.
Industry. Exactly.
We're off to ADIPEC next. We've got a conference there. We've got India's oil minister joining Yusuf Gamal Al-Din on the ground in Abu Dhabi.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. A chorus of hawkish Fed comments dislocates bonds. Loretta Mester suggests that rates may be higher for longer.
At this point, I suspect we may well need to raise the Fed funds rate once more this year and then hold it there for some time as we accumulate more information on economic developments and assess the effects of the tightening in financial conditions that has already occurred.
Meanwhile, in Australia, the Aussie slides as the RBA keeps rates unchanged, but says some further tightening may be required. And Kevin McCarthy's job is on the line. Fellow Republican Matt Gaetz officially moves to topple the House Speaker, teeing up a vote that may shift Washington's balance of power. Now, while the drama happens in Washington for this equity market, it's all about the debate unfolding of how much we need to care about higher rates. It definitely dented the Asia session. China is offline for the Golden Week holiday in China, but still the rest of the MSCI Asia Pacific falls more than 1%, almost 1.5% for the lowest level of this year, down 30% from its previous high. European equities, they have run out of steam. They started the morning higher. Now we're just ever so slightly lower. Meanwhile, S&P 500 futures, those also appear to be running out of steam. Manis, I know you've got the bonds in front of you, so I can't help but wonder if this has to do with the turnaround in this bond market, that equities are struggling now to get a bid.
Well, I think maybe the bond vigilantes set their alarm clock for 5 a.m. in New York, because in the past 30 minutes, I mean, we just had that light rollover in the bond market. The Fed speak overnight is very simply put from ING. It's the Fed pushing back against the rate market's protest. In other words, only pricing in 50% probability of another hike. You can see behind me, yields are just incrementally higher. Are you in some kind of a dislocation from normality, according to JP Morgan? That's their view. Schroders have just been with you and I saying real rates will go to 2.75%, and headline rates on the 10-year will go to 5%. We're already at the highest level since 2007. And it's the velocity of the change in rates, perhaps, rather than the destination that is most disconcerting. Ed Yadani says that it is about deficits and supply that are driving the narrative for the bond vigilantes. Now, the dollar flexed its muscle yesterday, rocking higher against sterling, against the euro. And again, the euro just makes a very, very incremental inroads to show some green on the screen. It tanked by nearly 1% yesterday. The chief economist has come out, Philip Lane, and said there is more work to be done. It's going to be hard to sustain these gas prices, the lower gas prices again. So an energy concern going into the winter. Crude is at $88, sub $90, and it had been dropping for 4 days in a row. So we're just trying to put it in an 0.1% higher. But again, it's the yield spike and the dollar strength that has sort of capped that run in the oil market. In ADIPEC at the UAE, of course, you've got Masroui, the oil minister there, saying we're on the right path. So there seems to be no relent from OPEC Plus in terms of the narrative about the cuts and the implementation of those. Danny.
Manis, I find this debate really interesting of at what point are we worried about how high yields have gone? As you mentioned, Schroeder said that it's not until after 5% that we should actually be worried. But Ed Yardeni says that the Fed should be worried now, that they should wake up to higher yields. The question is, Are we unduly tight right now, given where the level of yields are? Or does it just make sense? Is this just a logical pricing of higher for longer?
Or as Clock Tower saying, we'll catch up with Marco in just a moment, he said he wouldn't catch a falling knife. He salutes those people out there in the bond market that say, now is the time to pick up duration, but is not the base case for Clock Tower. So stay tuned, another 10 minutes, and we get the very latest from Marco Papik at Clock Tower. Danny.
Well, Manus, certainly the JP Morgan CEO, Jamie Dimon, has had some thoughts about this very topic. He's been warning clients and investors to prepare for a worst-case scenario of interest rates at 7%. He spoke to us exclusively on the sidelines of the JP Morgan Techstars Leadership Forum in London.
Can it go to 7%? The answer is yes. Are there factors that would drive it, higher than, where it is today? 4.5, 4.6, or 4.7 over the 10-year bond now. Yes. Is supply and demand could push high? Yes. I'm just saying, be prepared for it.
So
and then the worst case is stagflation. Higher rates because you have a booming economy and there's a lot of competition for capital is not the same thing as stagflation.
what are the ripple effects of the stress of that 7% rates on business, on your growth?
Well, I'm not worried about JP Morgan. JP Morgan, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too. That risk management is not the same thing as guessing the future. When risk management, looking at the range of potential outcomes and being able to say to yourself, we can handle this, we can handle this, we don't really expect it, and we can handle the in-between. If you bet your company on one outcome, so I think all companies do that. And every company's got different exposures. Input prices, output prices. Some interest rates don't matter. Some it's the price of mozzarella. So what's your business? Your business is different. So, but I think we don't know the effect of these things on the economy. So we may have a soft landing. We may have a mild recession. We may have a harder recession. Obviously there are potential bad outcomes. The worst one would be economically is stagflation,
right?
Where you have low growth, high interest rates, and obviously if that happens, you're going to see a lot of people struggling.
Regulators have proposed new capital rules that banks have said will make it tougher for Americans to get a mortgage. But I'm curious, when you look across the firm, what businesses are going to have the biggest impact?
When you get into the specifics, it really matters how the ultimate rules about mortgages and small business loans, et cetera. In general, it makes, what I don't like about it, for example, it punishes diversification, operating risk capital, and GSIFI. And diversification is one of the true free lunches for a bank that protects it. And I don't understand why they do that. And I just, we're going to be responding. Hopefully it'll be modified and thoughtfully done for international purposes. And mostly, America's got the best financial system the world's ever seen. And, that includes hedge funds and private equity and private capital, all things like that. But this is, I said that private equity hedge funds are dancing in the streets. And this time they're being quite public about it. Because this is going to push a lot of stuff out of the banking system. And if that's what the regulators want, so be it. Is that good for America? I don't know.
Some great lines there from JP Morgan CEO Jamie Dimon speaking exclusively to Emily Chang. So the bond rout continues. You've got multi-year highs. The Fed speak is ratcheting up. And the rates market, is it a protest from the Fed against this rates market? Let's get to Marco Papik. He is in the West Coast of America. His Clock Tower Group does not recommend buying or trying to catch a falling knife in this market. This is what you've got to say, Marco. We do not recommend trying to catch a falling knife. Bonds are not selling off today because of America's poor fiscal profile. The U.S. is not in a debt trap, but they may be in the future. So very good morning to you. Explain to me then why we've had such a violent shakedown in this bond market at the moment. Good morning.
Good morning to you too, Manus, and thank you very much for having me on the show. I think that this move in bonds is, at this moment, purely because of the optimism in the U.S. economy that was severely underestimated by all the Fed watchers. They thought that somehow the 12th Olympian gods on FOMC could somehow slow down the economy with Fed rate hikes. Of course, what was severely underestimated is the strength of the U.S. consumer. And what continues to be completely misunderstood by almost everyone in the markets is that there is no excess savings. That is a completely vacuous argument. U.S. households have far more cash on their almost perfectly clean balance sheets than anyone really thought. And so that is really powering the economy. And as it does so, bond yields had to reset to this collapse of the recession narrative that's occurred over the last couple of months. The problem, of course, with my view, is that if that's true, then that means that higher inflation expectations or some sort of a debt crisis in the US is yet to be priced if it does get priced in, which means the move on the yields could go higher from here.
Okay, I mean, you say that you're in the mild inflationistic camp. 3 to 5% is where we're going to settle. Has that reality hit home, Marco? But more importantly, if that is your reality, then what is the reality of where bond yields actually get to?
You know, so when you think about a 10-year fair value yield, there's really three components to it. One is term premium, which has risen because QE has ended. Then you have the R star, which is what we were talking about until now, just a healthier U.S. consumer than anyone really thought. The neutral rate is therefore higher. The long-term inflation expectations hasn't budged at all, Vance. So I'm in this mildly inflationary camp of, let's say, 3% for the rest of the decade. I mean, the five-year forward is basically telling you we're at 2.4%. It's nailed to the ground. So that's your long-term inflation expectations. A little bit forward are not much higher or lower. And that's what's really fascinating to me after all this extraordinary fiscal stimulus that we've had, after basically the Fed being way behind the curve in 2021, in my view, still being behind the curve. There's been no rise in long-term inflation expectations. And so when you put all those components down together, I think the fair value is somewhere closer to 5%. But don't assume that just because it's around 5%, we're there and so people should buy bonds. No, there's so many investors.
Why not, Marco? Why can't I buy bonds right now? We're almost at 5%.
Right. So because so many investors are holding hundreds of billions of bonds with the idea that the fair value is at 3 or 3.5. And if it's at actually 5, then it's likely the yields will overshoot as many investors sell their portfolio of basically overvalued assets.
Marco, with that landscape that you've just laid out in front of us, you also put forward the thesis that an outright move to yield curve control in the United States of America in the long term. I mean, you're not saying it's next week. You're not saying it's at the beginning of next year. We're going to get our comeuppance as a result of this largesse, the unnecessary fiscal stimulus. But what could invoke YCC? Because it's quite a radical thing to say that the US bond market would need YCC. How and why would that come to pass?
I think that would be some sort of an uncontrolled move in bond yields towards what, you had Jeremy Dimon talk about, like 7% in the 10-year yield. I think that, let's take it one step at a time. There is a self-correcting mechanism where once bond yields go over 5%, given where oil prices are, given where the 10-year yield would be at that point, you're starting to have a lot of headwinds to the economy. And if recession risk rises, at that point, I think yields would come down. Folks would start moving towards the safety. So yeah, I mean, that would be your self-limiting mechanism where I don't think we would need yield curve control. But if we get an uncontrolled move in bond yields, as you saw with the United Kingdom earlier in the year, what did Bank of England do? Or for example, after SVB, what did we do in the US? We instituted the Bank Term Funding Program, which is essentially an American style of European LTROs. Where you use the private sector.
To that point, we're at this moment, and again, to that point of the private sector, we're at this moment where debt is moving out of bank balance sheets and increasingly into non-banking financial institutions. And we have a Fed whose policy is transmitted through banks. Are we about to face a crisis of bond markets that can run away without that helping hand of the Fed?
Well, yeah, I mean, if there is no helping hand of the Fed, of course we could. Absolutely. As I said, if the fair value is 1.5%, 2% higher on the 10-year yield than most investors have thought, then many are holding overvalued assets on their balance sheet and they will start dumping them. And in that situation, of course, you have this uncontrolled move, the Fed will step in. And so I think that right now, investors are in a very, very dangerous moment. We're traveling with events. And I think the only real view you can have is on the 10-year yield. And then you have to watch how policymakers react to it.
some blistering warnings from there, and I'm going to quote you again. I mean, I got to say, I love this note. You, first of all, you put yourself up as being a heretic. It's brilliant. But yourself and the team there say, I mean, I wish I could be so honest at 5 a.m. on the show. The Fed is merely traveling with events. It's a price taker in CapEx in this cycle, defined by structurally higher aggregate demand. I mean, what did the Fed try to do in the past 24 hours? Because the rates market is fighting against the Fed. So has the Fed got to do more to regain control here, to regain the narrative?
You know, I'm not sure that that's what they need to do. I mean, the 10-year yield is in many ways doing what they couldn't do, which is slow down the economy. You know, and that's the point. That's the argument for buying bonds right now. Well, okay, this is unsustainable. Well, we'll see. We'll see which level is unsustainable. Market moves and paradigm shifts, when they get priced in, they tend to overshoot. That's why I'm not a buyer at this moment. But the point is that as the 10-year yield goes higher, that does increase borrowing costs for the economy, and that will slow down the pace of growth, even with my quite bullish view of the U.S. consumer. And so I don't think the Fed has to regain the control of this. I mean, it really depends what they're trying to accomplish. My issue is that I'm not really sure what they're trying to accomplish. I'm not sure that they know either. And that's why I think
Marco, you write in your note that it's clear that the Fed is pivoting for largely political reasons. I mean, that's quite the statement. Is it that clear? Why is it clear to you that it's political reasons behind their actions?
I think the reason for that is that, you know, inflation has fallen down almost purely for supply reasons. It is very difficult to see any sort of impact on demand by the increase in the Fed funds rate. U.S. consumers have just blown through 5.5% in terms of Fed funds rate increases. Continue to consume. You know, auto sales are up as rates are up. A lot of that has to do with very strong real wage growth. And so what I'm saying is that if the Fed really wanted to get us to 2%, they would have done that by increasing rates more. Instead, they're pivoting away from that. They're pausing right as we get confirmation that the economy is actually quite robust. And so I think the fact that we're 12 months ahead of the U.S. election, they don't want to be political. They don't want to be perceived as political, which they would be if they induced a recession for the sake of 2% CPI. I think that that is definitely playing a role in them pausing. But they're pausing as they pause and as investors realize that growth is much healthier than it is, that there's really no reason to hold bonds at 3.5%, 3.75%, 4%. You want to dump them, you want to sell them off, and that's creating this bond yield increase. If they didn't respond to that with some sort of a way to talk down the yields, that will be an uber dovish move that will definitely reveal that they have, you know, sensitivity to a very epic election coming up.
Okay, it's certainly going to be epic, and I'm delighted to be on the shores of the U.S. to watch it. Marco, let's give it a second go. I'll maybe get the name right this time, Marco Papic. Clock Tower Group, with his calls on bonds, politics, and an epic election to come. Thank you for staying up in the midnight hours on the West Coast. So the oil market is trying to steady itself. It's virtually flat at the moment, 90.68. We dipped for 4 days in a row into this session. We're live to ADIPEC in Abu Dhabi in just a moment on Bloomberg.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
When you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder.
This is Bloomberg Brief. I'm Manus Granny in New York. Danny Berger at London HQ. The oil markets are grappling. We're down 6% since the middle of last week. Lots of opinions out there. 90.69 is where we trade at the moment. Flat at the moment on Brent, and 88.89 just ticking into the green for WTI. Let's get to Yusuf Gamal Eldin. He's in Abu Dhabi at ADIPEC, one of the largest oil conferences. So it's good to see you there. I'm missing it. I'm missing the action. I would say the conversations around those halls will make for good reading. Are we in a good space of where OPEC Plus is at the moment? Yusuf, what's the feeling on the ground? Good morning, good afternoon.
Hey, so you've seen the volatility in the energy markets on both WTI and Brent. I mean, both stabilizing intraday. We were meant to speak to India and the energy minister. He got pulled to a meeting, and we're going to try and get some FaceTime a little bit later on because we're trying to understand what's behind the increase in shipments from Russia by 15%, according to the latest data by Kepler. So even though the thinking was they would phase that out, they're actually not doing that. And they continue to leverage the opportunity of cheap Russian energy exports. But of course, it is all about what constitutes a fair price in the current state of affairs. Because when I caught up with the UAE Energy Minister, Sohail Mazroui, he basically said the usual thing. They're not targeting a price. They're watching the demand side of the equation very, very carefully. When you look at the note from Citi in the last 24 hours, there's a good, solid argument to be made around the demand side of the equation and potentially demand out of China not holding up as strongly as many would have anticipated going into the new year. The other thing he highlighted is that they're going to stick by their capacity commitment. So they're looking to get to 5 million barrels per day by 2027. That means within OPEC Plus, they're going to have to look at some of the quotas again. But for this week, no change expected. Danny, Manus?
Yusuf, what has been the conversation there around the role of the non-OPEC countries? Just less than a minute here, Yusuf.
Well, basically, it is that it's being overlooked for the most part. As much as there's a call for OPEC Plus to increase the number of barrels they deliver to the market, you've got additional barrels coming online from outside of that group, as you highlighted. And the two in particular are the United States and Canada, as they've been ramping up their infrastructure and ironing out some of the initial bottlenecks within the system. So that's going to be a very important one to watch as we get to the end of the year, and potentially a new update from Saudi Arabia about their unilateral cuts.
Yusuf, thanks so much. That's Yusuf Gamal-Din at the ADIPEC Energy Conference in Abu Dhabi. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now let's get you set up for your trading day and a look at what is ahead. Atlanta Fed President Raphael Bostic will speak on the economic outlook and inflation at 8 a.m. Eastern. His remarks come before the JOLTS job report due at 10 a.m. Now we're also watching out for developments out of D.C. as Congressman Gates moves to formally remove Speaker McCarthy from his post as House Speaker, and the crypto fraud trial against FTX co-founder Sam Bankman-Fried is set to begin today.
Yep, well, we're going to keep eyes down on that JOLTS number. 9 million job openings, an increase of 175,000. That's going to be another piece in the bond jigsaw. That was a great conversation with Marco Papic. The radical thought that you could have yield curve control in the United States of America, but he made his call on fair value, and his fair value is
5%. Well, 4.5 to 5.
Okay.
And we asked Manus, okay, why wouldn't you buy now? If not, we're basically there. We're basically there at fair value.
His bottom line, I thought, was fascinating, which is there's a lot of hands have yet to fold in the bond market because the market is absolutely convinced the real value should be around 3.5%. So if the hands have yet to fold, how much higher can those yields go?
Yeah, exactly. It could overshoot, so maybe now is not the time to buy. All right, that's it from Manus and me on Bloomberg Brief.
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
so
destinations.
Functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, to having a drink with your friends or family. mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
This is Bloomberg.
The economy is quite a bit stronger fundamentally than it was in the previous cycle.
We're also just in an air pocket of economic uncertainty right now.
When you start to get to this position in the cycle, this position of monetary policy stance, the economy it only has so much more forward momentum.
I think in terms of something breaking, that could still be in front of us.
If rates continue to rise the way that they've been rising, eventually there's going to be a financial accident. Eventually something is going to break.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
470, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market slightly positive by 0.1% on the S&P 500. We have a new cycle high on a 10-year yield, TK 470.36.
It's the way we got here. It's not just a cycle high, but it's the second derivative of it, the first derivative, the third, fourth, and sixth derivative as well. It's a moonshot up in yield, and it's very technically elegant. Dean Kernet to start us strong here in the 6 o'clock. We'll talk about that. I'd link it into this massive correlation this morning in currency markets.
Yields up, dollar stronger.
Dollar's stronger, but it's the way it's stronger. It's stronger across everything. Maybe the Japanese are fighting a rearguard effort to keep yen off 150. It's sort of sophisticated. For non-global Wall Street, your head's going to be spinning with a lot of different numbers today, but the answer is markets are moving.
Here's a question for you. Can this equity market live with it? This one's from Bank of America, Savita Subramaniam, just yesterday. Equities can still work in a high rate environment. The S&P 500 returned 15% every year from 85 to 2005. On average. Lisa, when real rates were 3.5%, can we live with these real rates?
At this level, at this pace of increase, this is really a key question where Savita Subramaniam is actually among the Wall Street analysts in the minority, not the majority. You're seeing an increasing number of analysts come out and capitulate, whether it's Goldman Sachs, whether it's Morgan Stanley, although they've been calling for this for a while. This is going to hurt. It's got to hurt somewhere. And yet yesterday, tech stocks outperformed. So where is it going to hurt? It's kind of counterintuitive and not going back to the playbook people were expecting.
You're seeing the pain in the data. ISM manufacturing is getting better, not worse. Job openings out a little bit later. Looking ahead to payrolls on Friday.
The numbers are getting better.
Well, on one hand, you could say, okay, you're seeing actually a resurgence in manufacturing, but prices paid came in lower than expected. So this is sort of the white hope, right? Is that people are hoping that maybe we're going to get that immaculate disinflation, right. Even that strength is going to be a welcome thing.
The immaculate implosion is going to be commercial real estate. They're on short features. They're not 30-year mortgages. They're 5-7-year treatment. Everybody's going to refi. They may refi into strong hands and new money, but there's going to be some agony. The 10-year real yield, I've lost perspective, 2.33% is a true moonshot.
And climbing. Andrew Honhorst, Citi. Here's his view. You might be familiar with it already. This is his take. The upside surprise in ISM manufacturing further confirms that manufacturing PMIs have bottomed, could well go above 50. If that move above 50 materializes and is sustained, it would make a near-term recession, Bramo, even more unlikely. That's the take from Citi this morning.
It feels as if more people are coming around to the Hollenhorst view of things, which maybe is the reason why we're seeing that rise in yields. Maybe it's a sign of U.S. strength, or maybe it's something else. And this, I think, is important to really note. J.P. Morgan coming out this morning and saying something doesn't feel right. It doesn't feel connected to fundamentals. Ed Yardeni saying this is the resurgence of bond vigilantes. To me, it feels like people are testing when something will start to crack. And if it doesn't, well, then let's keep going, because let's get more yields. The supply-demand current dynamic would suggest it might be
Stuart
warranted.
Kaiser making a point that yields are rising for the wrong reasons, TK. That when you get upside surprises on the economic data and you get high yields, you can make that a good story. When you get yields higher off the back of Treasury refunding, the Bank of Japan pulling away from yield curve control, TK, I'd argue that things are maybe a little bit more difficult.
Yeah, well, I go back to the IMF 5-year view of a global slowdown, and granted, China is going to do okay here, 4 or 5% as a zeitgeist, but it's not going to do 5-6%. To your point on the reasons we're moving, all we can do is observe the data. And that's all the central banks can do, is they're completely data dependent.
Let's observe the price action. Equities right now positive by 0.1%, a small lift on the equity market. Yields high by a couple of basis points. Just south of that line in the sand at the moment, 470, 469.74. And in foreign exchange, 104 on the euro. TK, 104.85.
Yeah, and something, John, you've been on top of, I'm trying to get it up here right now. How about a 30-year bond in Germany? 3.17%. Their 3.17% isn't our 3.17%. Tell me that Europe doesn't have the same bond, debt, and banking problems we have.
Based on what we've seen in Germany over the previous decade, I'd argue 3% in Germany, Lisa, is something like 5-6%. In the US, something like that, maybe higher.
Considering we were negative and we had negative corporate debt being sold.
This is how they do it at Bridgewater. They just turn and say, yeah, it's equivalent to this in America.
6, 7?
Essentially.
It's kind of what it is this morning, you know, like 7, 8, why not?
Why not? Well, I mean, we can handle it. I will say that one thing that I find interesting is that with all of the Fed speakers, there is a consensus that they need to hold rates higher for longer, and there is a consensus that we don't understand exactly what's going on. 8 a.m., Atlanta Fed President Raphael Bostic, the latest among the Fed speakers, kind of giving us this ambiguous mush of we're watching stuff and we're not sure, which is kind of where markets are, and they don't like this interaction. 10 a.m., we get that JOLTS job openings data. Again, this was data that was discounted not that long ago, and then the pandemic hit, and all of a sudden this became the preeminent data highlighting the weakness or the strength of the labor market. We are expecting it to come in, but still remain strong, and today total vehicle sales will be trickling out throughout the day. This will be fascinating. To the manufacturing point yesterday of the ISMs, we're seeing strikes, we're seeing loan rates going sky high, and still they're expecting an increase in total vehicle sales. So just again, this sort of surprising strength underpinning a lot of the goods in addition to services.
Lisa, thank you. You're day ahead. Joining us around the table, Dean Kerniff, founder, CEO of Macro Risk Advisors. Dean, good morning.
Good morning.
Are yields climbing for the wrong reasons?
I would say so. Yeah, I think, it's not a higher for longer. As you noted, the data is coming in. It's not exactly accelerating, so it's not an increase in inflation break-evens. It's a real rate thing, and I think that's really just about indigestion. You know, the Treasury came and surprised the market with this new needs for supply, just a voracious appetite for deficit spending. Jonathan, I studied financial market history and specifically episodes of vol, and so we're at the 25th anniversary of LTCM back in 1998, and in doing the research on that, I learned a couple things. One is the Yankees won 125 games that year.
Okay, that's not happening.
Second, Sosa and McGuire hit 135 home runs combined.
Steroids.
And most importantly, the true five standard deviation event was that the U.S. produced a government budget surplus. And so that's not going to happen ever again. Also steroids. And so I think so much of this is the fiscal side. People use the term fiscal dominance. Obviously we had the central banks running the show for a decade post the GFC, and it's really flipped. And so I look at the back end of the yield curve as really a function of markets have got to clear at a certain price, and there's just too much supply coming against QT at the same time. So it's a precarious time.
Raises a really important question then. Is history any guide? When we start to say we can live with these kind of levels of real rates, is history any guide to whether we can live with this or not if yields are climbing for the wrong reasons?
Yeah, I would say not really. In fact, again, just looking at history, I was just remembering the bond market massacre from 1994. So this is unbelievable. It was October 1993, the 10-year yielded 5.2%. A year and a half later, it was at 7.8%, so a 250-odd basis point increase. Year-over-year CPI was unchanged during that period. So you can see how these rates can become unmoored relative to the inflation facts on the ground, but debt to GDP was 40% back then. It's now well over 100. So I'm concerned about that side of things. I would say that rates are a very self-correcting sort of thing. You know, Lisa, you talk about something's going to break. That's a rates lower situation. So either the economic medicine is ultimately going to work, and I would argue it absolutely will, leading to lower growth and sort of a lower just activity that brings down inflation, or something breaks. Either one of these is going to lead ultimately to lower rates. It's just a matter of when.
In the last 48 hours, finally, we've got the Dean Kernick question. OMG, we can't go back up unless we get catharsis. Do we need a catharsis to turn and move higher? Operative question this morning.
Yeah, I think ultimately for the market, and let's just use the S&P 500 as some example of the base risk asset, for that to become investable, we have to feel like we've seen the economic medicine take hold.
Give me a VIX number on that. Not the 2 digits. Just
Yeah, no, I'd say 25 to 30. I don't think it has to be a 50. You know, I don't think you have the potential for sort of some contagious event like 2008. But certainly you can go back to the 2022 episode where we saw VIX into the low 30s for a period of time.
What I find interesting about what you just said is that whatever pathway, whatever remedy, whatever monetary policy you end up getting, it's going to be essentially a self-correcting lower rates going forward. What happens if that doesn't happen? What happens if there is no financial accident? And this is sustainable, and we live with 4.7% rates. How much more volatility do we end up seeing in some of the risk assets that have been remarkably resilient?
Yeah, so again, I think about the two channels. One is the accident channel. It's the SVB. We were talking about losses on bank balance sheets due securities holdings. I think the increase in the 10-year was 40 basis points in Q2. It's double that in Q3. So we know those rates, unless there was some magical hedging we don't know about, those losses are going to be even more substantial. So I think the potential for an accident is there, but these higher rates ultimately are going to bite. And I think it's interesting to listen to the Fed speak. You got guys like Powell and folks like Williams that I think are more, hey, I think we're close to done. And then folks like Mester and Michelle Bowman who are saying, oh, I think there's one, maybe two more. But all of them say we're going to get here and hold. And I think even the holding is going to be quite a problem for the U.S. economy.
Who's feeling the pain from the increase that we've been seeing that just has been like a train running through?
Yeah, well, we know, obviously, the housing market is at a standstill. Your best asset on your balance sheet is your 3.5% 30-year fixed mortgage. CRE, that's going to be the first disaster. It's obviously already in motion, and the banks are a big funder of that. So I think, a lot of times the Fed talks about we're going to raise rates that's going to decrease the demand for things because the cost of credit, but the supply of credit is going to go down as well. Folks are sitting on decisions they made that turns out in hindsight were poor, buying 1.5% 30-year treasury bond. So that capital process, I think, is in the process of breaking down. And that's the second part. I mean, there's the accident part, and then there's the medicine of just lower availability of credit ultimately is going to take hold.
Have we neutralized that? The banks that are sitting on the long end, that are sitting on all these unrealized losses, some of these 30-year issues out of the Treasury from a couple of years ago, trading at something like 50 cents on the dollar. Has the Federal Reserve neutralized that since spring?
They have this obviously available for sale, hold to maturity, this sort of fictitious thing. We're going to put sort of a pile of them over here. And so, yeah, I mean, is there another SVB in the offing? I'm always never want to close the door on things like that. You've always got to really be looking over your shoulder for some episode of risk that you weren't contemplating. It's just to me that even if you don't get an accident, the supply of credit is going to go down because these folks are, in situations. Again, let's use CRE as the front and center one that's going to come first in terms of its maturity wall. That's where the supply of credit's damaged most quickly in 2024.
So sit in the front end and wait. Just let it play out.
Listen, I think of cash as a beautiful option right now. 2-year note at 5+%. Boy, you're getting paid to wait. And it's going to rally strong if growth gets dented and the Fed cycle gets upended.
Dean, this was awesome.
Thank you.
As always, Dean Kernick of Macro Risk Advisors.
Well,
cash is a beautiful thing, TK.
Well, cash is a beautiful thing. Good morning, Ray Dalio. But, what's interesting about this is the emotion or lack thereof that's out there. And I don't see the emotion in the equity markets. I have in the Bloomberg Total Return Index, a 2% down in price gets us to new lows for bonds. What's it going to look like on people's statements where Bud and Ethel go, how about that 18-month CD?
Well, here's the thing, right? is basically the stock market responding to this idea that essentially yields will go down, that there will be a financial accident. I know this feels like one step too far in game theory, but if people believe that if it's not sustainable, then you end up with yields going down, and if it is sustainable, then there's enough strength to keep the equity market going. Either way, heads we, win, tails you lose.
I would go back to the hope and prayer, not of the optimists, but people observing data. The 3-month annualized disinflation trend is well under 3%. That's not in the market right now. That's not being priced in.
This conversation is going to continue. Chris Harvey of Wells Fargo in the next hour, coming up very shortly. Terry Haynes of Pangea Policy on the latest in Washington, D.C. A serious conversation in the bond market about fiscal issues being priced slowly, then all at once. I'm not sure that serious conversation is happening down in Washington, D.C. The conversation up next. Live from New York. Good morning.
London and Sydney.
From Washington.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
I think the American people deserve to know the coalition that really governs them. And Kevin McCarthy likes to pretend that he makes coalition with conservatives, but all he really does is break his word with conservatives. The yellow brick road of working with Democrats has been paved, constructed, engineered, and architected by Kevin McCarthy. If he's able to stay in power, it will be him working for the Democrats, continuing to do their bidding. So this is a revealing exercise, and I think it'll show the country who's really in charge.
This is one way of getting attention down in Washington, D.C. Congressman Matt Gaetz of Florida speaking after filing a resolution late Monday to oust Kevin McCarthy as House Speaker. Live from New York City, welcome to the program this morning. As Washington, D.C. plays internal politics and fighting and all of that bad stuff, this is the market for you. Equities on the S&P 500 virtually unchanged for a second straight session. In the bond market, the sell-off resumes. Yields higher by a couple of basis points, just short of 470. Breached that level earlier on in the session for a new intraday cycle high on a 10-year maturity, 469.95. With that yesterday, the dollar stronger against absolutely everything in G10. A bit weaker against the euro this morning, 104.81 TK on that currency pair. But here we are down at 104, and the likes of Jordan Rochester over in Nomura on this program talking up, or rather talking down, 102.
I've got to admit, the euro's the story today, 104.82, and yen really doesn't move. You really wonder what the shenanigans are with the yen. I got a 149.89. I didn't get to a 150 on yen, and I think that's a lot to do with their system over there. But, you know, it's a different toxic brew than it was on Monday, but nevertheless, those tensions are there.
High of the session, 149.93 on dollar yen. We're like this far away.
Lisa, what do you think? What are you watching on the screen, Lisa?
I'm just watching bond yields. I mean, it's really that simple. 10-year bond yields and 10-year real yields. This is the story.
She hasn't looked at the equity market.
Can I just say,
since Nixon was president.
I was talking about how some of the tech stocks actually outperformed yesterday. I will just say this: even Kit Jukes came out from Societe Generale talking about how the FX market is just simply in the peanut gallery, watching the bond market, waiting for it to break something, and that seems to be the trade into the dollar. And we see that consistently, and we have throughout the past, I don't know, what, 10 weeks, 11 weeks?
10-year real yield, 2.35%, 2.35%, and that advances this morning. Should we do politics?
I'd love for you to do politics.
Let's do politics. Terry Haynes joins now with historical perspective, and this is what you've got to know in terms of the look back that we're doing. There are people that arc the American experience. Joe Cannon heard Douglas and Lincoln at the debates in the 1850s. Drag it forward 60 Joe Cannon years to 1910, where Speaker of the House, the gentleman from, I believe it was Illinois, was basically going to be thrown out. He survived. Terry Haynes on the new Joe Cannon, Kevin McCarthy. Terry, I look at this and I don't think there's any parallels there. What is the distinctive feature of this attempt against this Speaker of the House?
Really two, Tom. One kind of Washington small ball and one for the markets. The Washington small ball is that it shows that the House is pretty much ungovernable to begin with. You know, Mr. Gates wants to talk about, you know, that people deserve to know how the House is governed. Well, you know, he's showing them. Perhaps inadvertently, but in a bigger context, I mean, what markets see is there's no United States government attempt to deal with the debt or deficit, with entitlements, you know, anything else, and that failure is by and large bipartisan. Anybody that doesn't believe me needs to remember that they went off on vacation for 7 weeks instead of dealing with any of this. So this crisis is self-created. And, you know, at a time where you all have been talking about the bond market and a variety of other real-world consequences, what ought to concern everybody is that Washington doesn't even understand how its own governance failures are affecting the broader markets.
When you look at the government failures that are out there, what do the next 2, 3, 4 days look like? Don't they have a required 2 days to do something?
They do, and at the same time, there are procedural motions that happen first. McCarthy may well escape by the skin of his teeth, but the net of this is that, you know, the House has been a delicate coalition from day one, and it's going to get, regardless of how this turns out, it's going to get even more ungovernable, either with McCarthy there or McCarthy deposed, because whoever takes the job or thinks about taking the job is going to have even more onerous conditions placed upon him than McCarthy will. So this is very bad for anything fiscal, and even for avoiding a shutdown in 45 days.
Terry, I'm so pleased you touched on this. A conversation we had with Congressman French Hill yesterday, the privilege of acting recklessly. For a long, long time, Washington government has had the privilege of acting recklessly, to have big debates prolonged, messy over the debt ceiling, government shutdowns. Terry, a question we asked French Hill, and he responded by saying, I don't think they get it. Do you think they understand in Washington that they're losing the privilege of acting recklessly with the nation's debt?
No, I don't. I don't think they understand that at all. You know, it's as the great philosopher Gary Trudeau in his comic strip Doonesbury once said, even in utopia, there's myopia. The myopia here, the navel gazing here, the idea that you know, whatever kind of People magazine drama that goes on in the House or the Senate is the be-all and end-all of politics, and that they don't have a broader responsibility is rife. The lack of humility is rife everywhere. And that's going to continue. But that's playing into, as you all know, because I've heard you talk about it, that's playing into bigger market decisions. And the gradual degradation of Washington political credibility is something I think they don't even understand they need to pay attention to.
Right now, we're looking at a potential $1 trillion of interest payments in 2025, probably more at this point, given how quickly yields are going up. When does Congress have to actually address this, face this off, and account for this in a budget that's already crimped and really facing some concerns about pushback without really dealing with the big issues?
The last time they tried to do this or tried to start that process was about 25 years ago with a balanced budget agreement and surpluses that were largely disrupted by 9/11 and the fallout from that. When do they have to? Yesterday. When will they? As long as there is a closely divided Congress, they're very unlikely to. That said, one of the things I always tell you and tell markets is that don't misunderstand that there are lots of centrists in the Congress, in the Senate, and in the House who actually want to address all these things and want to do so in a responsible way. And, what we may end up seeing, probably not in this Congress, but the next, is the rise of those centrists to, once markets put pressure on them, frankly.
Terry, wonderful to get your perspective as always. Good morning to you, sir. Terry Haynes there of Pangea Policy. There's two issues, Lisa. Perhaps they're separate. You've got all the bond supply, the deficit, the debt pile. Then you've got the dysfunction on top of that. Is this playing off the dysfunction or just the debt pile, the debt supply?
From from what I've been reading, and I will sort of trust the experts in this more than myself, they really just talk about the debt supply, given the fact that it's increasing as much as they are. And the dysfunction goes to this idea that they're not going to get it under control. They're not going to reduce spending in any kind of way. There's not going to be a policy prescription to move forward. What is ironic about this whole thing, Fed's not buying until something breaks. Maybe then they'll start to lower rates. It's almost as if people are hoping something breaks in the market so that we can go back to an era that's gone.
Yeah, what's even more important, TK, just to jump in, is the context.
Yeah.
This is happening in an expansion, not a downturn. And I think that's what's difficult, to get this market to say, you know what, let's buy the 10-year. Let's go out and take on some duration. With the ISM improving, with jobless claims down at 200K, with unemployment with the 3-handle, Tom.
Yeah.
It's difficult to get there.
Dead on. And as Jamie Dimon said to Emily Chang yesterday, we have a technological edge. I mean, the people in America that benefit from technology are fine. There's a lot of other people where there's some stress, to say the least.
Perfect guest to talk about this, TK. Robert Tipp, PGIM, Fixed Income, joining us next from New York City this morning. Good morning. Equities up by about 0.1% on the S&P 500. A new intraday cycle high on a US 10-year, 470.36. From New York, this is Bloomberg.